We all know that the leadership of that particular part of his cabinet in the United States has raised questions for vaccine makers. So we'll watch that sector. And WPP in focus. They've given some pretty lackluster guidance. Revenue growth at -2% for 2025 in like-for-like adjusted revenue. And that was against an estimate of growing 2%. So, Guy, that's in focus.
Absolutely. Right. What is that all going to mean in terms of the opening trade? We are about to find out. It's Thursday. We're coming to the back end of the reporting season. There's plenty of ex-divs to factor in, plus a lot of corporate numbers that we need to think about, plus a macro story that seems to be the dominant theme. FTSE 100 starting a little bit negative this morning. We'll see whether that gathers a little bit of pace. Remember, these markets, as Critty was pointing out, are expected to be opening down circa 1% pretty much across Europe. I think you probably sort of average it all together. That's what you're going to get. So at the moment, actually, these numbers look relatively good, but they may gather a little bit of pace. We've got a few tricky trades that we need to make work this morning, so it could take a little while to get some of these stocks open. But there's a whole conflagration of factors coming together to bring a negative session maybe to Europe. But remember, yesterday was a really good session. So you need to factor that into your thinking as well, Critty.
Absolutely. A pullback from the outperformance that we've seen. That's perhaps the theme that we'll see when it comes to the DAX as well. You are seeing underperformance, though, in a lot of, I'm going to call it your core six here. Novo Nordisk, LVMH, ASML are certainly your biggest weights on this index. When you look at the upside, though, you are seeing a lot of movement in some of the smaller names, some of the energy exposed names I'm looking at here, Anna, when it comes to likes of Shell, when it comes to likes of other just kind of commodity names as well. But it's also important that the kind of idea of banks are also taking quite a bit of a hit. So an interesting mix this morning.
Yes, it's interesting. The energy sector is the only positive sector right now, isn't it? So that sector has just got its head in positive territory. Its oil services seem to be doing that. Valorec is one of the best gainers in that particular sector. But everything else really in red. But we take on board, Guy, what you were saying before about how that yesterday was a good session. So this is a bit of a reversal of that. We're watching to see how the auto sector performs, of course, with tariffs in mind. I mean, we feel like we've told this story a number of times, though, don't we, about tariffs are coming for automakers. Yep. And we don't have all of them open yet. So we'll see where that takes us. But something like Stellantis down by 2% this morning.
Versus yesterday's open, we're still up by 0.5%. So really, really strong session yesterday. We dropped this morning, we gapped lower, but the stock 600 maybe down 0.5% today, but on a two-day basis is still up by 0.5%.
Interesting. We haven't got WPP open yet, but some in that sector are weaker. So the media sector is suffering a little. Publicis is down by 2.5%. So we'll wait to see how the market responds to its London-based rival.
Now, we've talked a little bit about the Italian futures looking pretty grim as well. I just want to look at some of the movers on the inside of that in terms of what's weighing the index down. It's UniCredit, it's Stellantis, and to your point, it's Eni and NL as well. So you are getting that one, the banks read through and the energy read through. But then as we wait for the DAX, Stellantis, an early sign that things may not be looking good for the autos.
If you look at what is doing the damage in points terms, it's Novo, it's SAP. Now, SAP, and you and I were discussing this just before we came on air, could be a Salesforce story.
Yes.
So there could be some read across into that. ASML's in the mix, LVMH is in the mix. You've got Unilever and Diageo a little bit softer as well. But that feels like there's an index trade on this morning as well as a single stock trade.
Yes.
So it does feel as if Europe maybe is selling off on the tariffs, kind of the bigger picture narrative as well, plus also the big performance yesterday.
And might you sometimes find safety as markets are selling off in healthcare? Well, we do have concern around vaccine makers, so maybe not. Yeah. Bavarian Nordic is down by 1.5%. Maybe that's related, maybe not, but that is something we're watching, a developing story stateside as we look to see how the new administration deals with vaccines for sure.
Absolutely, and we should mention we are still waiting for the DAX to open. It closed higher by 1.7% yesterday, but early indications are that maybe that outperformance is not going to continue today. When we do see the DAX open, we we will bring it right to you. Go ahead.
Sorry, just wanted to mention the London Stock Exchange just opened. Yeah. Really strong performance coming through there. That's, in terms of the Stock 600, the London Stock Exchange is the best performing points gainer. It's up by 2.4%. So David Schwimmer's numbers, he was pointing them out as being strong. The market's certainly liking what it heard this morning.
Gave me just enough time to look at the DAX. The DAX is now open, down by, as expected, 0.9%. A lot of that, of course, concentrated in the auto space. I'm looking at Porsche, I'm looking at Volkswagen, I'm looking at Mercedes. How much of that is a pullback from yesterday? How much of that is Donald Trump's comments overnight? Let's get all of this under one kind of market analysis here. Anika Gupta, Director of Macroeconomic Research over at Wisdom Tree, joins us this morning. Anika, a pleasure to have you on this program. We're talking a lot about the tariff threat. We're talking a lot about the defense spending story as well. Which one is overpriced in this market?
Well, very good morning, Kriti. I think I would say that the defense story is the story that investors should pay closer attention to. I think the tariff story is a bit muddled because at one end we do get tariff announcements, and then at the other end of the spectrum we do hear negotiations, chances for a pause or an extension, and hence investors are still muddling through what actually is at play. And so far, we've heard a lot more noise than substance. If you think about it, the real concrete tariff in place is just the 10% tariff on China, whereas the rest of the tariff announcements are on hold. And obviously, overnight, we've heard tariff announcements on Europe, but we'll still have to see how it plays out. So I think the big focus for us here is really about Europe and its urgency towards securing its own borders.
Well, the fundamentals are certainly very much at play, but I'm curious, Anika, in the last 7 weeks or so, we've seen outperformance in Europe, and I'm questioning now the premium that's baked into some of these kind of geopolitically driven plays. Is Europe getting, I'm not saying it's there, but getting too expensive to own in some of the juiciest sectors that are catching all these fund flows?
Well, I think we have seen a bit of a concentrated rebound in European equities, and I think that's been predominantly focused around the exporters. So the exporters have had an outperformance within the European domain. And that's largely because the fear of tariff announcements had not hit us up until now. Also, we've seen a lot of front running in anticipation of these tariffs. So that's also resulted in escalation, in orders, and hence, an improvement in performance. I think now that we finally got this tariff announcement overnight, Europe is already taking that into account. It's already preparing for retaliatory measures. But at the same time, there are a number of avenues for negotiation. First and foremost, it comes back to defense. Europe has been lagging on its defense initiative, and now we're seeing a lot more commitment coming in from the UK, from France, from Germany, Denmark, really shoring up their spending requirements and spending needs within Europe. And I think that should be, a plus point from Trump's standpoint, where he said that, they're already scaling back. They already do not want to be protecting Europe's borders. So that's a step in the right direction for Europe. So there are many negotiating grounds, which is why I still believe there's further room to run for European equities. So maybe we see the exporters or the, primarily the cyclical segments take a pause, whereas the defensive parts of the market now have further chance of rebounding.
Anika, good morning. It's Guy. Given all of that, is Europe now an investment, or is it still a trade? Because to a lot of people, it still feels like a trade. It's tactical rather than strategic.
Guy, I think Europe is very much an investment, and that's because Europe has been, kept in the doldrums for a very long period of time. So the Russia-Ukraine war, brought back an element of geopolitical uncertainty that essentially, put away foreign international investment flows coming into Europe. Now that we've seen Washington signal this shift towards direct negotiations with Russia, and moving further towards a ceasefire, that removes a very, very important geopolitical risk element that was preventing international investors from investing in Europe. So I very much feel Europe is back on the investment front for global investors, and that's a step in the positive direction. So no more is
when you say global investors, Anika, when you say global investors, the conversations I have with US investors still remain, they still remain quite cautious on Europe. Given what you've just described, that's all in the price now. What needs to happen to get US investors to become serious buyers of Europe and to close the valuation gap that exists?
Well, first and foremost, earnings. We are seeing earnings rebound, and earnings are the key driver for equity market performance. So if we see those earnings continue to rebound, as we've seen in Q4 of 2024, that should be a very important catalyst. I think the second very important catalyst for European equities will be the dialing down of domestic political risk. So we're seeing, from the German elections, a bit more stability come back in. We're seeing France now gain its budget. So a lot of the political uncertainty on the domestic front that did take place in 2024 is now starting to abate. So I think that those two factors would be very important catalysts, moving into 2025.
Anika, can I ask you about AI? Big theme, of course, anytime NVIDIA reports numbers. NVIDIA's after-hours performance actually relatively stable versus other earnings days. But away from the companies that are really at the coalface of AI right now, into the wider markets, where have you got most confidence that we'll see AI deliver for European businesses? If more and more are going to be using it once those models are all trained for inferencing, where are you expecting to see those benefits come through?
Yes, so Anna, we've seen, like within the DAX index, given it's, it has more than 80% of its revenues are generated externally and internationally. That is one segment of the market that is likely to benefit. It outperformed in 2024. It started out on a very strong note in 2025, and it continues to benefit from the AI theme. So I think that we're likely to see a continuation of that take place, in 2025 as well.
And does fiscal spend, does that provide a catalyst for you, Anika? I mean, obviously, defense businesses are the obvious one there, but what are you looking for from the fiscal side?
Yeah, I think there's a very high likelihood that we are likely to see a reorientation of fiscal priorities. So I think we're going to see less spend on welfare, more spending on defense. There is likely to be a reorientation of carve-outs for, as they prioritize defense spending over other expenditures. And that could allow for a bit more loosening of the fiscal deficit here in Europe. So I think, yes, that could be a very important catalyst for the European economy going forward as well.
Anika, does Eurodollar at 104 help or hinder the bull case for Europe?
I'm sorry?
Does the currency, the potential moves in the euro, help or hinder the case for Europe?
So it very much helps, Kriti. So given the fact that Europe is an export-based economy, we have, we derive more than only 40% of our revenues locally. That 60% reliance on external revenues shows our dependence on a weaker euro. That could also be a very important negotiating front for, Europe with US on trade tariffs. So as long as the euro stays weaker, our exporters gain a competitive advantage. This is why we've seen a much stronger performance so far in 2025. And I think we are likely to see the euro move further and further towards parity, and I think that should also benefit, the exporter advantage. And I think the stance from the ECB amongst all the central banks globally, I think the ECB provides the most clarity on its accommodative stance. We expect the ECB to continue to move towards a neutral rate of 1%, and I think they should achieve that by early 2026.
Anika, great to catch up. Thank you very much indeed. Anika Gupta, Director of Macroeconomic Research, joining us from WisdomTree. Let's talk about what is happening with the markets this morning. There's a bunch of stocks that are really moving around a lot this morning. Rolls-Royce is certainly one of them. WPP is one of them as well. But take a look at what's happening with Ferrari. Everything on that board is red, which I think is interesting in itself. But look at Ferrari, down as hard as it is. The Agnellis are selling a roughly $3 billion stake in Ferrari. They are going to still remain as the biggest shareholders. But I think it's interesting that they are selling at the kind of current valuations that we are seeing right now. Anyway, the market obviously logically is taking this as a negative story, and the stock is down, as you can see, circa 6.5%. Ferrari's going to buy up around 10% of the shares disposed of by the Agnelli, so that's interesting as well. Let's talk about some of the other names we're watching. Some big movement this morning. Joe Easton's got the details.
So one big movement, guys, in Rolls-Royce. This incredible rally continuing in this stock. We're up around 15% at the moment. The company's cash flow guidance once again taking the attention of analysts. Better than expected. The beats and raises from this company cannot stop at the moment, and we're at another record high. Now, bear in mind, this stock traded for around £1 a share back in 2023, and we're above £7 for this stock now. A huge rally, one of the best performers we've seen across Europe over the past couple of years. A really big move once again in that one. Then we got WPP, as Guy mentioned, absolutely tanking this morning. The company warning of yet more slowdown seen in the advertising spending market. There was a bit of a buyback on that stock, but it doesn't seem to be taking much of the edge off that one. I think it might have just gone into a trading halt as well. There it is, ticking once again. WPP hit in the advertising space today. Then in terms of LSEG, a bit more positivity on that one. Of course, a lot of the business on the capital markets data, not just the exchange, and we are seeing strong sales from LSEG today, up around 3% at the moment for that stock. A decent return on that total income number there as well. Then over in renewable energies, we've got EDPR. This is over in Portugal. Now, some weak sales from this one. The orders missing expectations, and that one really tanking at the moment, coming down 11% for EDP over in Portugal today. Then in terms of the tariff exposure, we have seen some weakness, not just those red Ferraris. We're also seeing some red on Stellantis and Volkswagen in terms of the tariff news coming out of Trump last night. And also the drink stocks, Morgan Stanley out with a note saying that Trump's comments suggest potentially 20% downgrade to earnings estimates for some of these stocks. Then finally, going to finish on another massive price target for Rheinmetall. The company, again, another shout out for Morgan Stanley. They've put the price target at Rheinmetall on €1,300. However, they reckon that the stock could go to €2,000 if Europe starts spending 3% of its GDP on defence. We can see where that stock traded only around a year ago, around €400. It's up to around 1,000 now. Potentially it could double, according to Morgan Stanley, and the stock once again at another record high in Germany today.
Right, yeah, some of the spending in that sector really incredible then, or expectations of it at least. Joe, thank you very much. Joe Easton from our equities team. Coming up on the programme, European automakers are lower this morning, in focus after President Trump's latest tariff guidance. We'll dive into the details of that and plenty of other stories from the auto space. Craig Trudell joins us. This is Bloomberg.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. Bloomberg brings you breaking news 24 hours a day. Powered by 2,900 journalists and analysts in more than 150 offices across the globe. Bloomberg Television. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Welcome back to the opening trade. 8:19 here this Thursday morning in London. And this is the picture across European equity markets. Stocks Europe 600 down by 0.7%. The DAX under pressure, as you can see there, down by just over 1%. And in terms of other markets, yeah, we have the FTSE MIB in Italy down by 1.4%. We'll come to one of the reasons for that in the auto sector in just a moment. But it seems that the tariff story, Guy, then is one of the big themes that the markets are dealing with. But as you pointed out earlier, over 2 days, not so negative.
Yeah, the markets look pretty good. And the breadth today is really negative. So there's a lot of stocks moving to the downside. The auto sector is firmly in focus. You got a bunch of reasons for that. President Trump saying yesterday that tariffs on EU products will be 25%, could include autos. Who knows? We'll wait and see exactly what happens on that front. Joining us now, Craig Trudell, who leads Bloomberg's global automotive coverage. Let's start off with the tariff story. Did you discern any clarity from what could happen next from what President Trump said yesterday?
I mean, I think you said it best when you said, who knows? This is a sort of worst case scenario where you've got a great big cloud hanging over your head. And not only that, you have no idea when it's actually going to rain. Is it going to rain? You can only sort of prepare so much for that, potential, predicament to come your way. And there's only so much you can do in this industry, right? You can't, snap your fingers and add production capacity in the U.S. To whet Trump's appetite.
So that's one way of tackling the deficit that Trump has very much got his eye on in the autos sector between Europe and the United States is to produce more cars over in the US. Another way is to have more US cars come to Europe. But this doesn't seem as if this is, is that going to fly, Craig, in terms of demand from European consumers? I mean, you can get rid of any tariffs that exist, but will Europeans want to buy those cars that are much larger?
I think that's something we keep coming back to as a team is, how can this possibly be resolved in the sense that, the biggest U.S. automaker, General Motors, basically doesn't exist here in Europe anymore. They
sold. The American companies have been selling their footprint.
They've been gone. And so, they're trying to do a little bit of importing into some big cities with some, Cadillac electric vehicles. But we're talking like, handful of showrooms, really, really low volumes. Ford has been in this long-term trend of steadily declining sales. They do still have some local production here, but they've been closing factories because they continue to be in this bind of producing more than they can sell. And then you have Stellantis. They've got plenty of local production. Tesla has local production. There's not really a sort of big automaker that you can come up with where you can say, you know what, we can sort of balance things out here by one or the other sort of cranking things up.
This is all going to feed into the consolidation story or potential consolidation story over in the States. We're already seeing some element of that in Japan or lack thereof. Walk us through the Nissan story.
This is a huge story. So the CEO, Uchida, has been in the chair for some years now. it really has gone sideways. I think you have to take this back right to before he stepped in, and Carlos Ghosn leaving the picture in 2018. This is a company that really since then has been sort of steadily in a state of, if not losing money, really weak profitability. The outlook going forward, I think, is really cloudy because there's not a whole lot of product to get excited about. And, I think that this company was holding out some hope for a rescue, some help from Honda. That didn't go very far before everything sort of fell apart. So I think, the writing is on the wall here that they need help. The question is, will Honda re-enter the picture if Uchida steps down, and who can possibly sort of take over and help, sort of steady things for this company?
Let's talk about Ferrari. It's in the red this morning, as all Ferrari should be, but probably not exactly what everybody would hope for. So I had this theory that the Agnellis are selling because Ferrari's decided it wants to produce an electric car. Now, I'm sure I'm not correct in this, but it feels like a pivotal moment for the company. If it's not because they've decided to go down the electric route, which doesn't work out well for Porsche, what is it? Why are they selling? What's going on here?
I think this is a company that, is really, I don't know, it's not necessarily, the case that anything is simple or easy in the auto industry.
No.
And yet this is a company where you effectively run it by not necessarily turning the dials all that much. And so
it's the Hermes of the car.
Exactly. Yeah. And so, to your point, there is some radical product coming that, does raise some real questions about, is this the right move? And yet I don't necessarily see things going sideways for Ferrari with an electric model quite like we've seen with Porsche. This is a company that will continue to be relatively low volume, even much lower volumes than Porsche.
So, is this portfolio adjustment? Is this what are they doing?
I think it's a highly valuable company within their portfolio. I think they have trouble elsewhere in their portfolio. Stellantis being a company that is really struggling, as we've seen just in the last few days with a latest look at their financials. And I think they also mentioned Exor last night, an acquisition. And so I think we may see a sort of, next turn here, and it all makes a little bit more sense why exactly they're taking some cash off the table in the form of some Ferrari shares.
So we see that stock is down substantially today, race down by just over 7%. Elsewhere in the auto space, yes, there's some weakness, but not staggering amounts of. I mean, are we just waiting for facts on tariffs? And until we get real facts and actually implemented policy, perhaps, or dates, we're just in limbo here?
I think so. I think this is a sector that's been beaten down, pretty solidly going back to last year, and it's in part a factor of the tougher sledding. Right? You've seen the Chinese manufacturers come on the scene in a really emphatic way. Lots of reasons to be concerned. I think even just in the last few days, we've seen indications of BYD getting more aggressive here in China. I think everybody sort of, saw these Chinese companies coming into the European market and assumed they were undercutting on price. They weren't necessarily yet. Now we're seeing BYD start to get even more aggressive.
Craig Trudell leading our autos coverage around the world. We thank you so much. Coming up next, we're going to dive into the NVIDIA story. Is it a positive number or a negative number? We're going to dive into the details next. This is Bloomberg.
Behind the bright lights and adrenaline of pro sports is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I love the fact that you have, we say the cojones. I can't say that in Bloomberg.
Maybe moxie.
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're an asset, but how do you become the principal?
Paul Rabel.
We're going to be the league of digital, and that's why you're going to invest.
Adina Friedman.
I definitely am competitive.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. No, nobody does that. They say, let's talk about the team.
And so many more.
You need a clap?
No, I never.
Ready? Go.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Or other authorities.
Could face bigger challenges.
It was going to keep reading World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
This is the opening trade. We're at 30 minutes into today's session. You are seeing red across the stream. Stocks 600 down about 0.7%, but real underperformance in what have been the winners of the past couple of weeks. The DAX, for example, down about 1%. Seeing some pretty big negativity across the board as well. We're specifically keeping a close eye on European chip maker stocks in this hour, tracking the read across, of course, from those NVIDIA earnings. And we did see shares of the AI chip maker fall after hours trading after delivered good, but not great quarterly numbers, drawing a fairly muted response for investors. Let's do a little bit of investigative work here and bring in Matt Bloxham from Bloomberg Intelligence team. All right, Matt, walk us through this reaction.
Yeah. I mean, obviously, this is in the context of a month or so of DeepSeek news and these fears that that's a real big disruption to the kind of AI model, and that ultimately the big tech companies that are spending tens of billions of dollars each on NVIDIA chips won't need to spend as much because the kind of performance and efficiency of AI models will improve drastically. So you'll still get expansion of AI, but at much lower cost. And I think that question has not been answered. I don't think it will be anywhere close to being answered until next year. So I think, to some degree, what we saw here was, some expectations going into numbers that these are going to be really strong in terms of absolute numbers, but the ability for NVIDIA to keep really surprising on the upside is diminishing because we've had a few quarters where they have surprised. So inevitably, the market reacts to that. Analysts move their numbers up, get a bit more optimistic. And I think the slight kind of fly in the ointment here was the margin story. We were looking at some of the client chats yesterday as people talked through what they're expecting, and the optimists were hoping that the margin print would be better, and it was in line. It was 73.5%, I think, and they guided to similar margins to that for most of this year, with perhaps a bit of an improvement towards the end of the year. So I think that glimmer of margin boost would have maybe helped the stock, but because it was just in line, kind of saw a little bit of selling.
I just want to make a quick point on the analyst story, because the minute you mentioned it, I pulled up on our screen. NVIDIA shares closed at about a 131.28. That's the street low on the analyst screen. The street high is 220. So that's how bullish sentiment is right now from the analyst community.
Yeah, I think there's been a mindset shift, right?
Yeah.
Around this stock. It's never really recovered. It's down on the year, never really recovered from the DeepSeek hit. And it does feel as if previously there was kind of no caution. Mm-hmm. If you'd have posted these kinds of numbers a year ago, the stock may have had a very different kind of reaction. But it does seem, do you feel that there's been a sort of mind sort of shift? There's been a shift in the narrative around the stock that almost regardless of what they'd posted yesterday, the caution would have been there, that there has been a change in the way that NVIDIA is viewed and how important these numbers are.
Yeah, to some degree. I mean, I think inevitably if they'd really been on the upside with revenues, there would have been a good reaction. But yeah, I think there has been a narrative shift around not just NVIDIA, but the whole AI space.
Yeah, exactly.
And, I think you see a lot of questions for Meta, for Google, for Apple, for Microsoft, Amazon, these tens of billions of dollars you're spending, 50% increases year on year in CapEx, mainly on AI and data centers. When are you going to get a return on investment on that? And nobody's got a clear answer. There isn't huge confidence. They just know that this is everything's moving towards AI.
That's the question everybody wants an answer to.
Yes, and it's the question that every enterprise is starting to look at too. Okay, last year enterprises played around with AI. Where is the productivity gain? Where is the sales gain? And if they're going to continue to invest in AI, they need to see that. And that's not going to come through until next year.
And that's partly why Salesforce numbers were disappointing yesterday. Agentforce is their tool, which...
that's a really cool name.
Isn't it? But it only produced a modest contribution this year. More next is the line, as if we have to wait a little bit longer for Agentforce and all similar forces to get into action. Matt, thank you. I don't know why that's funny. Thank you very much. Matt Bloxham from Bloomberg Intelligence. Matt was talking there about data centers, and sticking with the AI theme, Bloomberg's Francine Lacroix spoke with the Brookfield Asset Management CEO Bruce Flatt about prospects for artificial intelligence and its infrastructure, including data centers.
The thing that I guess that hasn't really been factored in yet is that data center build-out really only started 10 years ago, and it was just getting started for cloud, and then the ChatGPT moment happened. And the amount of increase in requirement to train models and for learning is very, very significant, and we're talking trillions and trillions. So the opportunity for us, as we've always tried to move our backbone of the global economy along with what's changing in the world. And increasingly today, the world is digitalizing, and the final step of all of that is providing compute capacity. And so we continue to work on opportunities like that, but these are large, large sums of money. Some of these sites, like a 1,000 megawatt, 1 gigawatt data center site is with compute capacity, power to compute capacity all the way through is $50 billion. These are almost unprecedented investments ever seen in hundreds of years.
But are we overestimating or underestimating the pace of change that this needs to get done?
I would say you never know at the moment in time. But if I had to guess, we will. Everyone gets excited sometimes, but in the next 10 years, we will look back and be extremely surprised at the progresses that have been made. And probably the most important thing is that really what's happening is that it's the application of artificial intelligence into service businesses and industrial businesses, and the compression of the component of labor. And because of that, the productivity advances are going to be very significant. But that's going to be good for America because it means you can reshore capacity that you couldn't have made in the United States before, and that's going to continue to happen over the next 10 years.
Has DeepSeek changed anything for you?
I think all it does is show that when advances get made, they continue to get made, and progress, smart entrepreneurs figure out another way. And I'd say it makes the point. We are going to have better technology every day. We're all learning, and I'd say for us, what's really important is we provide the backbone of all of that. So we're providing the green power, we're providing the data center, we're providing the compute capacity, we're funding all of that, and that's different than we don't own a competitor to DeepSeek. If you did, you might worry about whether you had that. What it does mean probably is that there's more capacity required, which means they need more of our backbone. And as you bring costs down with anything, more use cases come about. And that's what's going to happen in the next 10 years as we evolve this business.
That was the Brookfield Asset Management CEO, Bruce Flatt, speaking, of course, with Bloomberg's Francine Lacroix.
Let's talk about some of what we've just been discussing, but from a different angle. President Trump says he'll impose 25% tariffs on the EU, quote, very soon, and they'll be directed at cars and other items. Not entirely sure there was much clarity there. The president also took a new aim at the bloc, saying the EU has taken advantage of the United States and was basically created to undermine the United States. Let's bring in Bloomberg's Brendan Murray, who leads our global trade coverage. Brendan, I don't often see the word murkiness in a Bloomberg headline, but there is one this morning that has murkiness in it. Can you look through the murkiness? Is there any clarity you can discern in what we heard yesterday from the president?
Yeah, it seems that Donald Trump has made so many tariff threats, he's having a hard time keeping track of the timeline for the rollout of them. I think what we heard from him yesterday was making a distinction between the tariffs that he's threatened on Canada and Mexico, which he's using as a negotiating tactic to extract what he wants out of the drug trafficking and migration issues. He seems to be the other way he's using tariffs is to rebalance what he sees as an unfair trade relationship. That's what it seems he's pointing the 25% tariffs that he said on all EU products, cars and everything else is what he said. That he's using it to reset that trading relationship. It's in the neighborhood of $800 billion to $1 trillion more in the U.S.'s advantage. He's made the example of cars. So he mentioned cars yesterday. So that appears to be in the 4 to 6 week time frame that he's laid out between the March 4th Canada and Mexico tariffs and the April 2nd deadline for all the others.
Brendan, some pretty strong language in response from the European Union. Is that all bark rather than bite?
I think it's a bit of both, but his response to a question about any kind of retaliation was, bring it on. He said, we're a bigger economy. He called the U.S. the pot of gold that everybody wants a piece of. And he said, retaliation by the EU won't work because we've got a bigger economy and a higher pain threshold than you do. So it sounds like it's typical tough talk from Trump. So we'll see if he follows through. But it sounds like he's at least willing to risk a trade war to resolve these issues.
It does seem then that as if there is still a lot of murkiness, to use the word Guy references, around trade tariffs and what they will look like for Europe, Brendan. But I know that Bloomberg Economics has done some work on the suggestion that we get a 25% tariff on Europe and what that will do to GDP. I think 1.5% would be the hit to GDP. These are the kind of stakes. This is the kind of damage that Europe could suffer as a result of this.
Yeah, exactly, and I don't think that includes any analysis about the damage to the U.S. economy and all of the uncertainty that it creates for businesses and consumers. Even we'll have to watch as we see economic data roll in over the next several weeks whether things like consumer confidence, business confidence are taking a hit from all this uncertainty.
Bloomberg's Brendan Murray joining us from Cape Town, of course, covering the G20, but also giving us the updates on the Trump tariff situation. We thank you so much. Coming up on the program, we're going to speak to Swiss Re Group CFO John Dacey after the Swiss reinsurer posted full-year earnings that beat the average estimate. More on that next. This is Bloomberg.
also an owner, I should have pointed out, of 3 major sports teams.
That's right.
And you're the first woman, as I understand it, the first woman to own 3 major, have stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the, I guess, the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, it was Abe Pollin. He did come to me and Susan O'Malley, and they said, Abe Pollin says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me, and I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Biggest possible risk for us as a company would be, I think it's clearly geopolitical risks. We are living in a more and more uncertain society. Political beliefs, which had been stable for decades, seem to be less stable or less certain nowadays. And I think this is the biggest risk we have currently.
Munich Re CFO Christoph Jurka there speaking to us yesterday about geopolitical uncertainty being the biggest risk on the horizon for his business. Let's talk about other risks for the reinsurance sector. Swiss Re says it expects claims from the Los Angeles wildfires to be under $700 million as the reinsurance and insurance provider saw net income rise to $3.2 billion in 2024. The Swiss Re Group CFO, John Dacey, joins us now. John, thank you for joining us. We just heard Munich Re talking about one big risk, which is geopolitics. Your earnings take us in the direction of another big risk, which is, of course, around climate. So let me ask you about the impact of the LA fires, either directly or more generally. We've talked about the numbers. Are you then going to reduce exposure to this kind of risk as a result of these fires? Is that an obvious conclusion?
Yeah, so just to be clear, we expect Swiss Re's losses for these fires to be less than $700 million, as you said. We think the industry losses to be approximately $40 billion between the primary insurance and the reinsurance sector. We don't expect at Swiss Re necessarily to pull back from these risks. What we do expect is to be able to price these risks correctly for both the underlying asset values, which are being insured, but also for the nature of the dynamic of the risk itself. And what we saw in January between the 7th and 9th, between the 2 large fires in Eaton and Palisades, was a massive conflagration started by what was an incredibly dry season, the 6 months preceding, where no rain had fallen. And then the Santa Ana winds, which were sustained at levels which actually hindered the firefighting abilities of the authorities for the first 36 hours. And it's one of the reasons why 16,000 structures were destroyed and why the losses were so concentrated and large in the complexity.
Yes. Yes, so one of the things you can do then is you can charge customers more for that kind of protection. I wonder, and I wonder what this means for the sector more broadly, and whether you'll be increasing your attachment points. So, for reinsurance businesses, the point at which they step in and help or support the primary insurer, are we going to see higher attachment points in the sector?
Well, our business model for the reinsurance is truly to take the tail risk of the industry. And that's what we've been doing for decades. And that's actually the attachment points we're currently at are ones we're comfortable with. It's one of the reasons why our losses are contained. Less than 700 million is still a very large number. Swiss Re in 2024 paid $37 billion in claims across our property, casualty, and life and health businesses. So it's not that we're not prepared to take on risks and to pay claims. What we need to be sure is that everyone, including individual policyholders, but local governments, has a clear understanding of what these risks are and the prices that should be able to be charged to cover a reasonable insurance policy for them. Our goal is to make insurance available. We just want to be sure that to the degree that there are mitigating actions that can be done either with building codes or actually individual behaviors, that those actions are put in place to help reduce the ultimate cost of loss.
Good morning, John. It's Guy. In the background, obviously, you have a huge investment portfolio, and what we are seeing in financial assets at the moment is an increase in volatility. How is the portfolio doing? Are you having to take out a bit of insurance for that as well?
It's a great question because, as you correctly say, a great part of our earnings comes from the investment income that we are able to earn on the assets that we maintain to eventually pay claims. Our portfolio is relatively de-risked. We don't have an enormous exposure either to listed equities or to other volatile assets. And in that context, our fixed income portfolio over the last 3 years has been performing better because interest rates generally, U.S. dollar in particular, has been rising in the durations that we care most about. And so we don't, while we're concerned about the volatility in these markets, we're not directly exposed in any large way to volatility in financial markets.
Okay, so let's talk about that kind of relatively low-risk portfolio you're talking about. Are you anticipating that yields are going to stay higher for longer?
Yeah, so we've, again, the duration of our liabilities tends to be between 5 and 6 years. We have an asset portfolio which largely matches that. And so what we've been doing is replacing expiring bonds that might have been bought when rates were lower in 2019, 2021 with the current rates. That's helped us get a better return through either government securities or highly rated corporate credit. And we'll continue to do that, and we think this will continue to be positive to the earnings growth of the Swiss Re, at least.
John, I want to go back to the point that Anna had asked you about. It's Creedy in London, by the way. You made a point around some of the climate kind of effect in terms of California and the fires there. There's also other parts of the United States you're exposed to that has that climate risk. You said the word repricing for the risk itself. That basically means higher premiums. Are you seeing a shift in demand for those higher kind of those insurance policies at that higher price? Are people more or less willing to kind of tap that kind of insurance policy?
So the quick answer is yes. What we see is that this risk is not something we're making up. It's evident to everyone. And whether you're in Spain and see the floods that occurred in 2020, the European storm Boris in 2024, excuse me, also last year, the 2 hurricanes in Florida that came up, Hurricane Helene, which came not only through Florida, but also into the Carolinas. All of these risks need to be evaluated. We run a set of more than 200 proprietary models for individual perils where we update as often as need be, but typically on a yearly basis, what these risks actually look like and what the asset values that are at risk are moving towards. And one of the challenges we have is people continue to want to live and build and construct in areas which are relatively high risk, whether it's 100 yards off the coastline of whatever country you're interested in, or in areas where people haven't built before but might be floodplains or at risk of these sorts of wildfires in Australia or in California. And so we need to help people understand what those risks really are and use these models to price them accordingly so that, in fact, people can make informed decisions about whether they want to put themselves in more risky or less risky positions.
So it sounds like you're saying that you are actually seeing demand despite that repricing to the upside, which brings me to another question around your one of your life businesses. You have there's a reinsurance deal between Equitable and RGA announced on Monday. I think it's about $32 billion of liabilities. Is there scope for more deals like that, perhaps even bigger in size?
I'm not sure even bigger in size, but yes, Swiss Re is active in this space. We see many of these transactions as they're being contemplated. We work with life insurance clients literally around the world and do a number of these transactions ourselves. In this particular transaction, we chose not to move forward, but Equitable is a great company. RGA is a great company. We think that there will continue to be an optimization of portfolios, and reinsurers can be very helpful in that optimization. Swiss Re first among them.
Thanks very much. Thanks, John. Good to speak to you. Swiss Re's Group CFO, John Dacey. Chrissy, we've dealt with a lot of earnings stories this morning. The tariff story, clear to see the effect of that on markets, but we still have plenty to come this morning.
We absolutely do. We are just beginning what's going to be a very full trading day, starting with some of the data right here in Europe. At 10 a.m. UK time, about an hour out, we get that Euro area consumer confidence data, and then about 12 hours later, 2.5 hours later, let me do my math there, 12:30 p.m. UK time, the ECB publishing an account of that January policy meeting. Stay around for one more hour and you'll get a data deluge out of the States. Fourth quarter GDP, January durable goods, initial jobless claims as well, and then a slew of earnings and Fed speak coming from the other side of the Atlantic.
Yeah, it's a busy day coming up. You've also got this Prime Minister's meeting, Prime Minister Starmer, President Trump. That's taking place in Washington a little bit later on. Technically, it happens on Thursday, the 27th. We'll be reacting to it first thing tomorrow morning. Obviously, this is part of the UK's, this conversation will be part of the UK's plan to build defence spending. The ask, though, is America still needs to provide a backstop for any truce between between Russia and Ukraine, and the United States needs to provide a backstop to that. At the G20, the UK's Chancellor weighing in on the need for increased defence spending ahead of that meeting.
We increase spending on defence to play our full part within NATO and to keep the continent of Europe safe against Russian aggression. In terms of the future trading relationship between the UK and the US, last time that President Trump was in the White House, trade and investment between our two countries increased, and I have every confidence that that can happen again.
Rachel Reeves, speaking in Cape Town. Starmer's ask is basically this: we will provide a lot of the troops in Europe going into Ukraine, but we still need you.
Yeah.
President Trump has said basically it's in your backyard, it's your problem. Where is the overlap ultimately going to be in that conversation?
Yes, and that's the specifics around Ukraine. We've heard from the UK Prime Minister just yesterday, then, Chrissy, increasing defence spending and more broadly, a real realisation that the price of a US security umbrella, the extent to which that still exists, that price has just gone up.
The cracks of the relationship, the transatlantic alliance surely showing. Marco Rubio also was supposed to have a meeting with the #2 over in the EU, Kaja Kallas. That meeting actually got canceled despite her trip to D.C. Risk sentiment is low in Europe. You're seeing that on your board. It does it for the opening trade. The Pulse is up next. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
this real momentum from Wall Street?
We're basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
NVIDIA fails to meet sky-high expectations, warning of tighter margins as it rolls out the highly anticipated Blackwell chip. President Trump says he'll hit the EU with 25% tariffs, but gives conflicting answers about his plans for levies on Europe, Canada, and Mexico. And European stocks falling as investors digesting news around geopolitics, tariffs, and AI. Now, also coming up in the program, our interview with the Brookfield Chief Executive, Bruce Flatt. We talk, of course, about some of the data centers and their 3 Ds, globalization, of course, and decarbonization. And the other one that we'll focus on. Now, Trump gave contradictory statements on Wednesday on the implementation of tariffs, keeping investors guessing. This is why it's panning out a little bit like this on the markets. Now, the U.S. 10-year yield, a lot of the focus on markets is also markets saying, look, we now need to move the narrative from inflation to weakening growth. If you look at the tariffs, so White House officials saying that European levies could affect all exports from the bloc or only specific sectors. Trump's administration also remains on track to put levies on Mexico and Canada. Unclear if they get enacted in March. Euro dollar 104.78, and then we also had a good conversation on some of the other commodities. NVIDIA, also that outlook, mixed outlook, comes at a shaky time for the AI industry after the Chinese startup DeepSeek sparked fears that chatbots can be developed on the cheap. So that is also part of this investor appetite picture. So for all of what you need to know, the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, NVIDIA has delivered a mixed outlook, drawing a muted response from investors after 2 years of blowout results. Now, this is what NVIDIA is doing pre-market, practically unchanged. It comes amid concerns about slowing spending on AI technology. Now, for more on all of this, let's bring Matt Bloxham from the Bloomberg intelligence team. Matt, I mean, they weren't bad results. I know they underwhelmed, but is it because we're expecting too much, or was there actual disappointment?
I think it's more that market expectations are pretty high. I mean, I think they've become a little bit more tempered given everything we've heard about DeepSeek. And the revenue in the quarter was about 2% ahead. I think people are used to seeing revenue like 10% plus ahead as this kind of revenue surge has come through. And I think so expectations have kind of adjusted to kind of reality of how quickly this company is growing. And as you said in your kind of lead-in, margins were perhaps a little bit disappointing. They came in line in the quarter, 73.5%, but they guided to keeping in the low 70s range most of this year, perhaps ticking up to the mid-70s by the end of the year. And I think some of the optimists were looking for a positive surprise on margin to kind of help temper that softer news around revenue, and it didn't come through.
Is AI in a bubble? How often do you get asked that?
Yeah.
Every day, every hour.
Yeah, exactly, yeah. I mean, it's a good question, and I guess there's a lot of ways of defining bubble. I think the one thing's for sure is that AI is here to stay. It's going to be part of everything we do in our business lives, our social lives, government. The question is whether it's going to make money or not, and that's the big unanswered question right now. I think clearly, all the big tech companies spending tens of billions of dollars, capex up 50% year on year, most of that going to NVIDIA. If that doesn't flow through to increase revenue, better productivity, then they're going to have to find new ways of delivering AI, and that will kind of temper demand for people like NVIDIA. But it's an unanswered question. I don't think we'll even start to see any hint of the answers to that until we're well into 2026.
Matt, thanks so much. As always, Matt Bloxham there from Bloomberg Intelligence. Now, Salesforce also gave a fiscal year revenue forecast that fell short of estimates, dimming optimism that the company's new AI product would spur faster sales growth. You can see almost down 5% from Salesforce pre-market. Bloomberg has also learned that U.S. health officials are reevaluating a $590 million contract for bird flu shots that the Biden administration awarded to Moderna. So Moderna also on the downside, some 4.4%. Now, President Trump gave contradictory answers at a cabinet meeting about his plans to enact tariffs on Canada and Mexico, as well as the European Union. Now, the president says he'll impose 25% tariffs on the EU very soon and took new aim at the bloc. Now, for more on all this, let's bring in Ross Matheson, our EMEA news director. So, Ross, what do we know about the 25% tariffs on Europe? And good morning.
Good morning, Liz. There's actually a lot we don't know about the 25% tariffs on Europe, because we don't know, as you were saying earlier, whether this would be across the board on all goods that the EU sends to the US. We don't know whether it would target specific sectors of goods. We know that Donald Trump has cited specific things before when it comes to other countries, for example, lumber with Canada, autos, chips, possibly the pharma sector. So certainly he's got his eyes on a certain number of sectors when it comes to the EU. And the auto sector is the one that's particularly anxious about the possibility of having tariffs on auto goods. But we really don't know what this is going to look like. We also don't know when such tariffs might even take effect. We don't know whether they would take effect with a lag like we're seeing for other places, again, like Canada and Mexico, possibly with a further extension still to come. So it's very, very unclear. And in that environment, how do you manage the run-up to that? Obviously, the EU is warning we have our own list prepared. We are ready to retaliate if needed, but also they're playing it fairly low-key at the moment because they want to really see more clearly a sense of how this is going to play out from the US side.
Rose, Francis Macron was also in Washington this week. The UK Starmer is going today. So are they lobbying for tariff relief or are they pushing for Ukraine?
Well, probably a bit of both, really. I mean, it's all in the frame again that to the US, and the message to Donald Trump is that on Ukraine, for example, he really needs Europe involved. And here's why, including for the future peacekeeping of Ukraine after a ceasefire is agreed. When it comes to the economic message, again, it's like you are trying to build relationships potentially economically with China, with Russia, but you also need your allies in the tent here, and that includes Europe and the UK, and we can play a role, obviously, in all of that. And you can see the message is both that we're hearing you when you talk to us about trade and you talk to us about defense. We're showing you we're listening. We're doing things. For example, we're looking at picking up our defense spending significantly in the region. So we're getting that message from you, but also at the same time, we're prepared to hit back if needed on all those fronts. And really, given the interlinking of these economies, this would be damaging for the US to do so. So it's a bit of a complicated message and all of that they're delivering, but it's really the idea that, yes, they understand the concerns of the US. They are listening to those. They're trying to show that they're responding, but equally, they're willing to hit back the US if needed.
Ross, thank you so much. As always, Rosalind Matheson, they're on the very latest geopolitical news. Now, to piece it all together, let's bring in Ursula Marchioni, Head of Investment and Portfolio Solutions, EMEA at BlackRock. Ursula, thank you for joining us. I mean, you have the great joy of trying to figure out geopolitics, NVIDIA, and try and make sense of it in a portfolio. Is tech overvalued now?
Very good question. Thanks for having me, first of all. I think that more than overvalue, what we are observing is a normalization of a 2024 that set a very, very high bar on multiple fronts. If you think about markets, US performance, clearly poster child of that, within that tech. But at the same time, also a very high bar in terms of the confidence for investors to put cash, take it off the sideline, back to work. We saw 1.8 trillion flowing into the ETP industry. We saw mutual funds collecting inflows. So again, we have seen that big deployment. Moving into 2025, what we are observing is a normalization, I think, of many of the trends, coupled with caution from investors and a US administration that is now in place, feet under the table, starting to test the boundaries on many of the trade-offs that they'll need to think about. They did come with a growth agenda. They still talk of a 3% growth ambition and target. How is that going to connect and pan out with, domestic policy, DOGE as an example, or the tariffs discussion? We're seeing a journey for Canada and Mexico. Is there going to be a journey about Europe? And to your colleague's Rosalind's point, how is it going to unfold?
So for the moment, just on the back of NVIDIA, do you just leave tech to one side because it's priced to perfection, or do you still have to own parts of it?
No, we like tech. We continue to like tech. We are in the early innings of AI. To Matt's point, this is here to stay. We often compare it to an industrial revolution. It is clear that the dynamics are changing. You can talk about a broadening of what we have observed. So if you look at China tech, for example, and what we have observed year to date, that is potentially a positive sign of this trend broadening out beyond the US and actually becoming more of a global component, which will drive, growth. I guess the element there is, to Matt's point, how is it going to play out from a timing perspective? So looking at client flows, we have come off from the huge purchase of AI that we saw towards the end of last year. Month to date, in February, we saw outflows actually, primarily, paradoxically, out of China tech, probably domestic investors taking profit. US tech sectorial flows have been flattish. So again, I don't see, for instance, a sign of a bubble per se. I see a sign of a normalization, but also a positive component of broadening.
Ursula, when you look at some of the bigger questions, if we broaden it out with geopolitics, there have been data points from the U.S. that are starting to worry, and you see the markets kind of shifting from their worries on inflation to their worries about a possible downturn, what the Fed deals with that. Do you worry about the U.S. consumer? Do you worry about the U.S. economy?
US consumer, some sign of weakness in labor market, you're right, are coming through and need to be taken into account. At the same time, if you zoom out, the story around US exceptionalism is a multifaceted one. It is one of, if not tech, global leadership, certainly a very high performance and level of advancement. It is a story of, deep capital market. It is a story of energy independence. And broadly speaking, of a macro picture that, compared to other regions, European one, remains positive. Hence, the two diverging paths for 2025, Fed versus ECB. So I do think that these elements that are coming through are to be taken into account and obviously are impacting markets. At the same time, it's too early to, call a multifaceted story of exceptionalism as an ended one. And we see that in flows. We remain overweight US equities, but also clients continue to like US equities, although more interest for Europe is clearly also filtering through.
In terms of some of the sectors that you like, I know you remain positive on tech. Is there anything else like healthcare or industrials that you think is a good entry point right now?
Yes, I think healthcare is another one that I would definitely look at. And also moving from sectorial to regional, we have recently moved to neutral in terms of Europe. So we upped our conviction there. I know obviously we're now the morning after several discussions from the U.S. administration.
Unclear discussions for the moment,
Unclear discussion, right? Exactly. And, you know, year to date, we still need to acknowledge that we've seen a first leg of a rally which has been powerful, driven by, you know, a reduction in political risk premium, driven by, obviously, the valuation point, which is significant. I believe Europe is an area to watch. We do need to see, you know, the macro and the micro, so growth and earnings playing out and bottoming out for a second leg to unfold, but that is definitely an area, in addition to the sectors, that I think goes back to that element around from 2024 to 2025, we're seeing a normalization and a broadening from tech to regional opportunities.
Ursula, thank you so much. Ursula Marchioni there from BlackRock. We, of course, continue following what they say very closely. Now, coming up, European natural gas gains, breaking the recent extended slump. We'll be joined by the co-head of Global Commodities Research and head of natural gas at Goldman Sachs. That's next, and this is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Versace in Davos, Switzerland, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment. Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Now, European natural gas prices are up this morning, snapping a recent drop that sent the commodity into oversold territory. Let's discuss all of this with Samantha Dart, head of natural gas and co-head of Global Commodities Research at Goldman Sachs. Sam, thank you so much for joining us. Look, you're in one of the most exciting spaces right now for the right or wrong reasons, but there is a lot going on. Prices have been fluctuating quite a lot. What are you expecting gas prices to do from here?
Yeah, so when we think about European natural gas markets, we do see two-sided risks for this year because on one hand, we have this possibility of a ceasefire deal that might lead to a proper peace deal that might lead to additional Russian gas flowing to Western Europe. But at the same time, when you look at natural gas inventories in Europe today, they are extremely low. So there is a very real physical problem right in front of the market. And as a result, you end up seeing this volatility. If you get headlines that seem to favor the probability of a deal, then you get a sell-off, and then maybe not, and then you get it to ramp up. And the reason is, if we have this tight market, what the market needs to do to solve it is to price high enough to attract enough LNG imports. So you're caught in the middle of two-sided risks, really.
But Sam, I mean, you say it, you know, beautifully, because there's no guarantee of a ceasefire, and even if there's ceasefire, you don't know what happens next.
Right.
Is the trajectory slowly up, or is it just impossible to determine what happens next?
Yeah, so we see our base case for this year is really around 50 euros a megawatt hour, so slightly above where we are now. But we think this is a level that would be high enough to attract imports and manage storage. What is interesting for us in this market is that when you look at global natural gas balances, there is a lot of new LNG production that is being built as we speak, and that will come online over the next several years. So we don't think this is an upward trajectory forever. We think that, yes, this year is tight because inventories are low. If we can get through this year, the trajectory, in our view, is actually down.
Sam, do you think the sell-off was justified? Again, some of the actors, you know, say this is speculation, maybe speculators closing their book.
It is difficult to pinpoint every price move because, again, it's always this attempt to measure what's the probability of an actual deal happening, right? So this volatility, I think, is very well expected. What I think is a risk for the market is if we have, for example, prices dropping below 40 euros a megawatt hour, because the lower prices go, the more this market would be inviting other buyers of LNG to come in. And the more they buy, the less LNG is available for Europe. So there is a risk there of pricing too low too soon.
Yeah, and this is mainly competition from Asia, which I imagine have been buying. Can Europe compete in that space? If you just look at the European energy space, I know I speak to a lot of chief executives, they keep on saying, this is what's really holding me back.
Right. So I think Europe has been lucky that Asia had actually a mild winter this time around. So Asia hasn't been competing for cargoes very much. But this can well change into the year, especially if prices drop. The cheaper they are, the more they'll invite buyers in.
Yeah, and we've been quite lucky, actually, in Europe also with the fair weather, right, over the last couple of winters.
The last couple, you're absolutely right. This winter was a little bit different. Cold. We got a little bit of cold and especially low wind. The lower wind you have, the more you need to rely on natural gas to generate electricity as well.
So I know a lot of, and you've mentioned this, that actually a lot of the storage was depleted. I mean, does it make Europe quite vulnerable? Are there other sources that could come in to kind of support energy demand?
Right. So you have depleted storage for this year, but we're not going to run out. I think the main challenge is the lower storage goes now, the harder it'll be to refill ahead of the next winter. So that's the big challenge today. And that's why we think that gas prices need to be high enough to at least try to attract enough imports to guarantee that this is going to be a successful refill of storage.
Yeah, I mean, there's also a complex situation in the Middle East which impacts some of the imports from, you know, the gas-rich countries. Does that get any easier in the next couple of quarters?
So the Middle East tensions, they haven't disrupted gas flow that much because even though the Red Sea has issues with transit, you've had essentially a lot of Qatari volumes that would have come to the UK, they stayed in Asia, or they go around Africa because freight is actually really cheap right now. And a lot of US cargoes that might have gone to Asia stayed in the Atlantic. So you haven't really disrupted that many volumes with the geopolitical tensions in the Middle East. So this is not a huge driver.
It's more, one of the trends could be that actually you now only deal with partners and friends. And so as the world is getting more divided, do you see more, for example, Qatar LNG going to places where they wouldn't have in the past?
Yeah, that's a good question. You know, the way we think about it is these volumes will likely go to whoever is paying the highest price, right? So in a year like this one, where Europe is the region that is tight, we think that is going to attract enough LNG. Going forward, honestly, I don't see a lot of natural gas demand growth out of Europe. We expect that to show up in Asia. So when we think about where these volumes are going to go, our expectation is that a lot of those will head to the Pacific.
Sam, thank you so much. It was so great to have you on the program. Sam Dart, there, head of natural gas research at Goldman Sachs. Now, much more to come. This is Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. Bloomberg brings you breaking news 24 hours a day, powered by 2,900 journalists and analysts in more than 150 offices across the globe. Bloomberg Television. Context changes everything.
Rolls-Royce, big gainer in Europe this morning. That's after it raised its profit guidance and said it plans to buy back £1 billion of stock as the aircraft engine maker seeks to extend a 2-year turnaround. You can see Rolls-Royce gaining some 15%. We'll have plenty more in the markets. The market's also focused on these possible tariffs from Europe after what Donald Trump said yesterday. There is a bit of confusion about the global tariffs timing, but also the scope of what they would hit. Coming up, as crude steadies near its lowest close this year, we get the latest on the oil markets. Francisco Blanch from Bank of America joins us next. This is Bloomberg.
In case you missed it, from Bloomberg's coverage at Davos.
Do you think there's one particular thing that you'd like Trump to change in terms of what some people see as the over-regulation of banking in America?
I don't believe, honestly, that we should have a huge amount of deregulation for larger banks. I think that's, you look back at COVID and any crisis, big banks now are strong, are able to step in and being part of resolving issues rather than being the one that creates issues. So I wouldn't really welcome a huge wave of deregulations. What I can see is that, of course, what happened in the US doesn't mean automatically that you will see in Europe or in Switzerland or in Asia deregulation. So the fact is that US banks may become even more competitive internationally through a more benign environment.
Nobody covers Davos like Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take 2 numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacroix here in London, and these are your top stories. NVIDIA fails to meet sky-high expectations, warning of tighter margins as it rolls out the highly anticipated Blackwell chip. President Trump says he'll hit the EU with 25% tariffs, but gives conflicting answers about his plans for levies on Europe, Canada, and Mexico. And European stocks actually fall as investors are digesting news around geopolitics, tariffs, and AI. Now, a couple of things that we need to bring your attention to. There have also been a lot of earnings out in the last couple of days. Look, on the global tariffs, it's very clear that Trump gave some pretty contradictory answers about his plans to enact tariffs on Canada, Mexico, as well as the European Union. Now, we did have a White House official afterwards clarifying the deadline, but it's kind of whipsawed markets a little bit. The focus firmly is on growth and whether markets now need to focus a little bit less on inflation, higher inflation, but now growth being hit in the U.S. So oil pretty much steady today, near its lowest close this year, with tariff threats from U.S. President Donald Trump and supply issues in focus. Now, Brent crude trading close to $73 a barrel after losing 3% in the prior two sessions. For more on this and the wider picture, let's get straight to Francisco Blanch, who heads up commodities and derivatives research at Bank of America Global Research. Francisco, so happy to see you. There's a lot going on in your space.
Thank you for having me, Francine. It's a pleasure to be back in the studio.
When you hear POTUS saying drill, baby, drill, does it impact actually your longer-term forecast for oil demand?
It kind of doesn't, because ultimately, remember, in the U.S., the drilling activity is dictated by the market. So to the extent that prices are high, we see more drilling, and to the extent that prices are low, we see less drilling. Now, having said that, there is a deregulatory push that we are seeing. For example, some of the methane rules that were part of the IRA are being scrapped, and there's other potential measures that will relax these tight regulations that Biden's trying to put around the oil and gas sector in America. And that might help on the margin increase drilling, because it will help reduce the marginal cost of production. But you still need high prices.
There are, a number of things that have impacted the price of oil is, of course, supplies in focus, and the fact that there have been supplies from certain countries that have come under focus, but also tariff threats.
Right.
So how do you see demand panning out, actually, for oil over the next 8 to 10 months?
So tariffs and obviously a risk of tariffs creating uncertainty and eventually lower industrial activity in a recession, that's perhaps one of the biggest downside risks to the market, and comes really from the demand side, right, as you pointed out. So we are worried about it, because the last time that we had a tariff war in 17, 18, we know what happened. I mean, global PMIs ended up falling 7 or 8 points, and we started at 58. Which is a pretty healthy expansion. And now we are on the edge of contraction, and this is just starting. So it does worry us, the uncertainty. That's a key concern. Having said that, the market's still giving President Trump the benefit of the doubt and saying, well, this is all a negotiation tactic. And to be fair, Colombia was threatened with tariffs for 24 hours, and then those tariffs were taken away. Mexico, Canada, the same story. Now it's the European Union. How much of this is real? How much of this is not? It's hard to tell, and I guess that's part of the strategy, to keep everybody second guessing. But if tariffs indeed go into effect, I think it'll be pretty bad for the U.S. and economy as well. I think it'll be bad for the global economy, but also for the U.S. economy.
I mean, on the supply side, and this is something I know you follow very closely. Look, there's things going on in Venezuela and Iraq, right, but the big one is really Russia. If we're going to normalize, relationships with Russia, which is big if, how quickly could that come, and what happens to the price of oil?
So there's, I think, 3 elements to any Russia deal. There's going to be, obviously, an element around the geopolitics of it, the territorial claims, and there's going to be an element around the financial elements. Remember, Russia still has $300 billion in foreign assets frozen in Euroclear, which, by the way, is one of the reasons why gold prices have rallied so much, right? But then there's the issue around energy, right? And of course, this meeting that we saw last week took place in Riyadh. So you have Saudi Arabia, Russia, and the U.S., the three biggest producers of energy in the world, sitting together around the table. Hard to believe that there was no energy discussion in that meeting. But I do think that if we see relaxed sanctions on Russia, on the U.S. side, we'll see lower energy prices. And if we see relaxed sanctions from Europe, we'll see even lower energy prices. So I think, believe it or not, the U.S. needs Europe a little bit to cooperate here for energy to come down a lot, right? So we'll see how that plays out. Obviously, Keir Starmer is in the U.S. today. Macron's there earlier in the week. So, but I think if sanctions are relaxed, indeed we'll see lower prices. But we need to see that first, right? Now, the market will discount some of it, but we need to see that reaction. And frankly, how much oil could we get from Russia? Maybe 400,000 barrels a day incrementally, not a huge amount, but we'll see a lot more diesel. Russia was the world's biggest exporter of diesel, was the second largest exporter of petroleum products in the world before the Ukraine invasion, after the US of A. So if sanctions relief comes to Russian petroleum products, we will see lower diesel prices at the pump, and so on. The other thing that we'll see potentially is lower European gas prices. Right. European gas prices have been extremely taxing on European industry. And, you know, again, this really is going to depend very much on Europe and how Europe deals with this Russia-Ukraine situation. But if sanctions relief come through and we see more Russian gas flowing into Europe, which could come through a number of venues, that would substantially reduce the energy prices in Europe, and frankly will give a big boost to European industry, and also potentially to European defense as well, because Europe needs to spend more money on defense. And are we going to make 100 tanks, or will we end up with just 10 tanks at the end of the day? And I think the more resources that Europe can get to get that defense spending going, the better. The difference it'll make. Francisco, talk to me a little bit about Saudi Arabia, because I think it was 4 days after President Trump got inaugurated that he started, telling basically Saudi Arabia in a very public forum, you need to again just put more oil out so that the price goes down to help him out. Right. What happens? Well, so remember, Trump has put himself a huge constraint coming into office. He promised to lower taxes, and unfortunately, he's got a $2 trillion budget deficit to deal with. So when you're not going to raise revenue, right? When you say you're going to cut your revenue, you cut your taxes. It's kind of hard to increase it, right? So he has to look at expenses. How do you bring down expenses? Defense is a part of the discretionary. A lot of the debate that we're seeing today is about defense, because the U.S. wants to cut back defense spending, which is discretionary. But also, President Trump doesn't want the interest expense of the U.S. government to keep going up, which means that he needs inflation to come down so interest rates can come down. And that's ultimately the issue, right? So if Trump can convince the Saudis and the Russians and the Europeans to bring energy prices down by allowing more supply to flow in the market, you end up with lower inflation, potentially lower interest rates, and therefore reduced pressure on the U.S. budgetary accounts, which, by the way, the U.S. is spending more money on interest than it is on defense now. But Francisco, so what kind of level could they bring it down to? Again, there's balances to be, the budgets have to be balanced also in Saudi Arabia, and they've lost a lot of money in the last couple of years. Absolutely, and this is the challenge that Saudi faces. They're kind of stuck in a tough place, because on the one hand, they have a $95 a barrel budget break even, but of course they produce oil for a very low level, $5, $10 a barrel. So on their side, it's like, we need this money to build the country, and we've also promised to invest in America $600 billion, so we can't really send oil to $40 a barrel. The one thing that Saudi can do, of course, is say, well, we'll make up in volume what we're losing in price. Again, this is a very tough pill to swallow, but maybe one that will be discussed, right? So, because remember, today Saudi has 3 million barrels a day of spare capacity. Is exporting 6 million. So Saudi could increase production by 50%, right? And even if prices go down 20%, still end up with more money in the bank. So again, there's a little bit of room. Now, of course, that will lead to much lower energy prices, and I'm not sure that's the outcome they want necessarily, but because that will also impact U.S. production. So it's really all a fine balance. But I do think the Saudis would definitely not like to see 60 to begin with. They would like to see higher prices, higher volumes. But ultimately, you get what you get, and hopefully you don't get too upset.
Francisco, thank you so much. Terrific briefing. Francisco Blanchler, Bank of America Global Research Commodities and Derivatives Research Head. Now, coming up, our interview with the Brookfield Chief Executive, Bruce Flatt. We talk opportunities from AI, the impact of Trump's tariff threats on consolidation. That's coming up shortly, and this is Bloomberg. From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
DOJ or other authorities
could face bigger challenges next.
Was going to keep rain World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Increase spending on defence to play our full part within NATO and to keep the continent of Europe safe against Russian aggression. In terms of the future trading relationship between the UK and the US, last time that President Trump was in the White House, trade and investment between our two countries increased, and I have every confidence that that can happen again.
Well, on tariffs, I think from the EU side, to see how things materialize over the course of the next few months. Of course, we want to be constructive, but we should not be naive in what's coming.
Carlos Cuerpo, Spain's finance minister, and before that, the UK Chancellor, speaking to Bloomberg at the G20 finance ministers meeting in Cape Town about relations with the Trump administration. Now, one of the world's largest asset managers says progress on AI, particularly from China, will be a huge opportunity in the years to come. Well, Brookfield is investing tens of billions of dollars in data centers and other infrastructure, betting that AI will become even more widespread in the economy. Now, the firm's chief executive, Bruce Flatt, sat down with me for a wide-ranging interview.
The thing that I guess that hasn't really been factored in yet is that data center build-out really only started 10 years ago, and it was just getting started for cloud, and then the ChatGPT moment happened, and the amount of increase in requirement to train models and for learning is very, very significant, and we're talking trillions and trillions. So the opportunity for us, as we've always tried to move our backbone of the global economy along with what's changing in the world, and increasingly today, the world is digitalizing, and the final step of all of that is providing compute capacity. And so we continue to work on opportunities like that, but these are large, large sums of money. Some of these sites, like a $1 megawatt, 1 gigawatt data center site is with compute capacity, power to compute capacity all the way through is $50 billion. These are almost unprecedented investments ever seen in hundreds of years.
But are we overestimating or underestimating the pace of change that this needs to get done?
You know, I would say you never know at the moment in time. But if I had to guess, we will. Everyone gets excited sometimes, but in the next 10 years, we will look back and be extremely surprised at the progresses that have been made. And probably the most important thing is that really what's happening is that it's the application of artificial intelligence into service businesses and industrial businesses and the compression of the component of labor. And because of that, the productivity advances are going to be very significant. But that's going to be good for America because it means you can reshore capacity that you couldn't have made in the United States before, and that's going to continue to happen over the next 10 years.
Has DeepSeek changed anything for you?
I think all it does is show that when advances get made, they continue to get made, and progress, smart entrepreneurs figure out another way. And I'd say it makes the point. We are going to have better technology every day. We're all learning, and I'd say for us, what's really important is we provide the backbone of all of that. So we're providing the green power, we're providing the data center, we're providing the compute capacity, we're funding all of that, and that's different than we don't own a competitor to DeepSeek. If you did, you might worry about whether you had that. What it does mean probably is that there's more capacity required, which means they need more of our backbone. And as you bring costs down with anything, more use cases come about. And that's what's going to happen in the next 10 years as we evolve this business.
Bruce, if you're sitting in Europe, there's concern that actually you're being left out because China's going one way, the U.S. is America first. You worry about inflationary pressures and trade wars. What does that mean for Brookfield? Are there opportunities to be had? Again, we're a local investor in countries. We're building out data centers all through Europe. We have the largest builder of data centers in Europe. We just announced a big deal in France for $20 billion. In all of our businesses, we continue to invest across the backbone. We're local players in local countries. We sell local things. And sometimes less money being available and less positivity means greater opportunity because there's less money available and therefore the opportunities are better. And so we're always selective with what we do, but I think there are still significant opportunities in Europe. On private credit, you're a big player in private credit. Where do you go from here? This business is going to get bigger. Our business and the industry in total is going to get bigger and bigger because this is just capital being pushed off of banks' balance sheets. It's less regulatory friendly on their balance sheets. They don't really want it on their balance sheets. It's being pushed to sponsor groups who are usually lending in the area where they have a lot of expertise. And our two biggest businesses today, or I guess three biggest businesses, are real estate infrastructure and direct lending in corporates, because we have a lot of expertise in those things. We just bought an asset-backed lender called Castle Lake, and we're going to continue to build out the business merely because I think the scale opportunity is there, and our clients can earn extra return in private credit than they can just buying bonds in the market. And that's really we're here for our clients. We're here just to service them, and if they can earn an extra 100 basis points over what they'd get somewhere else, this is a very exciting place for them to put money. How much bigger do you think this market can get? Again, if you're good, it seems like you're doing really well, but if you're in that mid-level... Yeah, we're $300 billion today. I think it can be much, much larger. In what kind of time frame? Look,
It will grow. With us, we always try to grow methodically.
Right.
Once in a while, we buy something, but we grow methodically. It can grow. It can double, it can triple, it can quadruple over the longer term, and we'll just keep building it out. But I'd say the thing we want to make sure with every business we have, we're super responsible. The foremost thing we have to do is make our clients the returns we promise them. And if we can do that, this business will be very, very large 25 years from now.
Do you expect consolidation in that space, in your space?
Look, the asset management industry started from nothing 30 years ago, circa 30 years ago. There are 5 or 7 big players today. Some of us have done acquisitions to add in other sources of skills into the businesses. We've done some, others have done some. I think there's going to be it's never, one size never fits all, but there's going to be some very large players. We're one of those. And then there's going to be some niche players that fit a certain area. What's happening in the middle is so far in the last 18, 24 months, it hasn't been easy for them to raise money. We raised $135 billion last year in our asset management business. Not many others can raise that type of capital.
Well, more of our conversation with Bruce Flatt on the impact of Trump's policies in just a moment. That's next, and this is Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment. Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern, only on Bloomberg. Context changes everything.
Asia is at the forefront of some of the world's biggest stories. I'm Chevrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Brookfield Asset Management says it's still positive on the United States despite uncertainties from President Trump's policies. Here's more of our conversation with the Chief Executive, Bruce Flatt.
What we try to focus on are long-term trends and focus on the long ball. And within that, there are going to be fluctuations all the time. I'd say everything that has happened over the last year is all positive to the long-term theses we have. We're still going to digitalize the world, and we're going to do it faster, and we're going to have more. We're still going to deglobalize, and we're going to do it faster, and we're going to have more. And we still are going to transition to renewables, maybe not because of renewables, but because we just need more power. So I think all those three trends are maybe more important today than they were before. So we don't get too wrapped up in the day-to-day effects of what's going on rates or economy or different things like that.
Has your U.S. business been impacted at all with some of the Trump policies?
What we do is go to great countries, invest in great businesses or assets on the backbone of the global economy with great people. And we don't trade over borders. So in the United States, we have $500 billion worth of assets. They're all local assets. We sell the goods to local companies and people, and we're a local company, as we are in every other country of the world. So there's no doubt there's always some ramifications on everyone, good or bad. But for us, it's pretty small because we just invest in places and we don't trade over borders.
Bruce, when you look at regions around the world, where do you see the big next opportunity?
We're in 30 countries, and therefore, and the success of our investment strategy for many decades has been to have global business and to be able to pick the spots where value and price don't intersect. Where markets are up a lot, we're selling things, and where markets are down a lot, we're probably buying things. And so I would say it always differs. In Europe, for example, it's a value market. Multiples are lower. In the United States, the trends behind what's going on in the United States are very large. So they're just different opportunities. But I would say if I had to pick a spot where more capital will go over the next 18 months, it's probably in the United States.
The Brookfield Chief Executive Bruce Flatt there. Now, Bloomberg has also learned that India is exploring ways to lower tariffs on a wide range of imports, including cars and chemicals, in a bid to evade President Trump's threatened tariffs. Also, Elliott ramping up pressure on BP as a turnaround plans falls short. That's another Bloomberg story. We'll have plenty more throughout the day, and this is Bloomberg.
What about quantum computing? People talk about that. Is that something that I should be looking at investing in?
I've made a lot of mistakes, betting on these new technologies like AR, VR turns out to be not so big, 3D printing turns out to be not so big. My estimate is $100 trillion was invested in today's dollar in the PC, CPU-based infrastructure. All this is going to get ripped out to put $100 trillion or more in our GPU-based infrastructure. In that sort of quantum of numbers, I feel that the quantum computing is going to be very small.
You always are worried about, I presume, geopolitical events. So are there some geopolitical events you're worried about right now?
Yes. I don't know why, but for some reason, I love thinking about black swans. And at the office, everybody thinks I'm weird because I'm always thinking about what can go wrong. But underpinning the AI is the chips. And the chips, despite the CHIP Act, which I think was a good idea for the US, I still think like 80% or so of the capex of TSM is in Taiwan. And so at the leading edge, a lot of capacity is in one very small area. Forget that it's just in China, it's in a very small area. I think that's very risky.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Global headquarters in New York. I'm Danny Berger. Manus Cranny is off today. Welcome to Bloomberg Brief. Let's set your agenda. Good but not great. NVIDIA warns of tighter margins as Blackwell production and trade risks loom. Tariff confusion, President Trump's contradicting comments, and a vow for European levies weigh on the region's stocks. And after 6 days of decline, Treasury yields push higher ahead of jobless claims and a marathon of Fed speak. Well, did NVIDIA make or break the market? Maybe it did basically nothing for this market. NVIDIA shares pre-market, here's the thing you want to know waking up. They're only higher by 0.6%. They were good. They beat. It's not the huge explosive beat that maybe we've gotten used to. And then you get a picture like this for the overall markets. Your U.S. futures are still higher this morning, up 0.5%. NASDAQ up 0.6%. Russell 2000 up 0.8%. It seemed to be the tariffs that we've been trading on, not necessarily NVIDIA. The confusion of the timeline, we'll get into that, what it actually means. But Trump did talk about a 25% levy for Europe. So you saw there at the bottom of your screen, European equities moving lower this morning. Here's your bond market this morning. 6 days of declines for yields. That was the longest losing streak since September of last year. We move higher this morning. We get jobless claims. Will we get some hint of what some of the layoffs in D.C. mean? Your 10-year yield at 4.3%. Some stocks we are keeping our eye on this morning. Let's get a check on Moderna share prices. Bloomberg sources say U.S. health officials are revaluating a $590 million contract for bird flu shots. Those shares down 4.33%. That award did happen in the Biden administration's final days. Elsewhere in earnings, Salesforce shares, they are falling in the pre-market 4.7%. It gave an outlook that was weaker than expected. It dimmed optimism that Salesforce's new AI product would ignite sales growth. Elsewhere in tech earnings, Snowflake jumping this morning, up 10.5%. The cloud computing company projected better than expected revenue growth for the fiscal year. It earlier also announced an agreement with OpenAI, which will access its models directly through Snowflake's system. Coming up in the hour on deck for you, we will be speaking with Paul Donovan of UBS, Priya Misra of JP Morgan, and Frank Lee of HSBC on NVIDIA earnings. Speaking of which, we saw those small moves in the share of NVIDIA up about 0.6 this morning. It gave some mixed outlook. CEO Jensen Huang did talk about the amazing demand for Blackwell's chips.
Blackwell is going to be incredible across the board. And when you have a data center that allows you to configure and use your data center based on, are you doing more pre-training now, post-training now, or scaling out your inference, our architecture is fungible and easy to use in all of those different ways.
Let's bring in Bloomberg's Tom McKenzie on this. Tom, what were your takeaways from the earnings?
Look, Danny, this is a market that has the muscle memory of a company that has just missed
quarterly earnings just once in the last 5 years. This was not a miss, as you say, in the most recent quarter. In fact, they came up with a modest beat. And then the guidance for the current quarter, so the spring quarter, the quarter that includes, of course, April, was actually slightly above the consensus, $43 billion US, but not hitting the top end of some of those estimates. Some of the analysts out there had expectations of $48 billion in the current period. We're not there, but we're above consensus. You heard there from Jensen Huang around the rollout for the Blackwell chip. He says that's very strong. It's the fastest product ramp-up in history, is the way that he characterized it. So clearly the demand is not softening for Blackwell. The margin may be a little softer. They've guided on a slightly softer margin, around 71%. Still pretty enviable in terms of a margin for a business like this, but down from the 73% that historically, or at least in recent years, this company has managed to squeeze out. There are still lots of unresolved questions. This is a market, these are investors who have to adjust to growth that is continuing for NVIDIA. This company's not going anywhere fast. It's not going away in terms of its dominance of artificial intelligence chips. But is it going to get the growth that it's had in the last 2 years? That seems to be in question as the CapEx spend continues, but we still need to know whether things like DeepSeek are really going to rewrite expectations beyond 2025 in terms of the spend, and then questions about tariffs and as well restrictions on that Chinese market. But for the top line, current quarter, a little above consensus.
Can we get into the tariff issue, Tom? Because the stock was up in the pre-market, and then it starts to fall when you get the CFO talking about tariffs. This market doesn't have much clarity on whether it's going to happen. Does NVIDIA seem like it has any clarity on their impact?
Well, there's the potential supply chain impact of tariffs. Wherever they land, whatever they fall at, whatever the number is, of course, they produce their fab, their main fab, of course, that they use is TSMC's over in Taiwan. So there's some complexity and unanswered questions on that front. I think arguably the more important potential headwind for NVIDIA when it comes to geopolitics is a Trump administration that is now looking at increasing the restrictions on the chip sales into the Chinese market. Chinese companies like DeepSeek, like Alibaba, like Baidu can still buy the H20, slightly older chip, repurposed for that Chinese market. Is this a Trump administration that's looking to curtail that sale? That is potentially important. And that, for me, on the geopolitical question mark for NVIDIA, is the one to watch.
So you have the geopolitical question, Tom, and you mentioned this in your first answer, the DeepSeek question. There was this moment where Jensen was talking about the need to compute heavily, that the amount of compute required for reasoning going forward is 100 times greater than the one-shot prompts. It seems like we've moved far away from that DeepSeek freakout, that there's still so much demand and so much power needed in what's the next generation of chips.
It was quite the freakout, wasn't it? It was, what, almost $600 billion of market cap that fell from NVIDIA, historic in terms of the market drop. Jensen Huang, certainly the team at NVIDIA, want to frame this as not a question about derailing their business model, but a question about cheaper models and faster and more rapid adoption that leads to longer term, just greater growth when it comes to AI demands. Jensen Huang sees this as being the first early innings of this AI revolution. A question for analysts, and I keep coming to questions because there still are unanswered questions, is about return on investment. The hyperscalers are getting some of that, but point to an enterprise where you're getting clear ROI on the embed of AI, and that is still something of a murky issue. Where is the return on investment for enterprises that are adopting AI? We don't yet have clear clarity or a clear steer on that. Even as Jensen Huang says, there will be greater adoption, models come down, more open source becomes cheaper, there'll need to be more chips, not just for the training, but for the inference as well.
Tom, thank you so much. Bloomberg's Tom McKenzie there tracking the NVIDIA earnings. Just one thing to mention for you, breaking from the Wall Street Journal, a story just coming out, that Microsoft is set to publish a blog today that would push the Trump administration to loosen and simplify a new system that restricts the sale of chips. We know that the Trump administration is looking into further restrictions for chips to beef up what the Biden administration did. Again, Microsoft set to publish a blog today calling on them to ease the limits of said chips. We'll keep an eye on that for you. Let's get some other top stories that are trending on the terminal this morning. Bloomberg sources say that Nissan is planning to replace its CEO, Makoto Uchida, after the collapse of talks to combine with Honda. The 22-year company veteran has been CEO since late 2019. Uchida told reporters earlier this month that he was prepared to step aside if asked, but first wanted to steady Nissan's business. Goldman Sachs President John Waldron is joining the bank's board of directors. The firm has been seeking to keep its top talent like Waldron from leaving the firm. It's a rare move to elevate a banker who isn't a chief executive to the board of directors. Bloomberg sources report that YouTube star Mr. Beast is looking to raise a couple $100 million in a funding round that would value his company at about $5 billion. He is looking to expand both his packaged goods and media business. Talks are still in their early stages, and it's not yet clear who will invest or if they will do so at the target price of $5 billion. What a world we live in. Coming up, Paul Donovan of UBS will join us. We'll talk tariffs, the confusion, what's coming to Europe, what the calendar might actually look like. All of that comes up next in your brief.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people,
the tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment. Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Clarify the Canada-Mexico tariffs. You had put that 30-day pause, but you just referred to April.
25%.
25%. When does it go into effect?
April 2nd.
April 2nd for Canada-Mexico.
Correct.
And
for everything.
That was the President Trump there at his first cabinet meeting, and those comments were followed by a White House official later clarifying that the deadline for Canada and Mexico does remain on March 4th. You heard Trump there talking about April 2nd. Naturally, that caused some confusion. Here to join us is Bloomberg's Brendan Murray, who's been in Cape Town for the G20 finance ministers meeting. Brendan, can you make sense of it? Do we understand what the timeline might actually look like for Canada and Mexico tariffs?
Well, it sounds like the president's signaled that there is some flexibility in that March 4th deadline for there to be a delay in those tariffs. Now, he didn't say that specifically, but him mentioning that April 2nd was the date for those, suggests that perhaps Mexico and Canada, in some last-minute negotiations, can deliver what he wants them to on the fentanyl restrictions and the migration issues that Trump has raised with them. So the White House officials told us afterwards that the March 4th is still a live date, but the president may have tipped his hand there that there's some flexibility to it as well.
This is the thing. He just often says various tariffs, and it leaves market participants scrambling, or maybe lack of scramble, just kind of brushing it off, saying, I don't know whether to believe this. Because, Brendan, he also talked about the EU. What did we hear from the president on possible tariffs there?
Yeah, so what he said about the EU is interesting as well. He said 25% tariffs on cars and all other products. So that's, nearly $1 trillion trading relationship between the U.S. and the European Union. The European Union quickly responded and said, "We'll strike back if that's the case." And then the president said, "Your retaliation, couldn't possibly stand up to the economic pain that we can inflict on you." So. There's a lot of, kind of tough talk going on between in the transatlantic trade relationship right now, but that's pretty standard stuff as you before you sit down at the negotiating table. It sounds like the Europeans want to negotiate and would be willing to do so to give Trump some things that he wants, like lower car tariffs. But we'll have to see how those talks get scheduled in the weeks ahead.
Well, again, it gets to this question, what are tariffs for? Are they ways to raise revenue? Are they ways to even trade balances? And what does that mean how companies respond? Brendan, we got this from India, according to people familiar, at about 5 a.m. this morning, that India is weighing tariffs cuts on cars and chemicals to help appease Trump. Does it seem like that tactic has any movement? Is this a time for negotiations between countries in the U.S.?
Well, it seems like India is scrambling to offer something to show President Trump that they're being proactive about lowering their trade barriers. The U.S. and India have long had some contentious discussions about how protected India's economy is compared to the trade barriers, the lower trade barriers for Indian products in the U.S. market. So it sounds like the two leaders, met in Washington recently, and it sounds like India is trying to get a few things that they can offer Trump before his reciprocal tariffs, which is the big broad penalties that he wants to put on countries, not just to even out tariffs, but to even out things like value-added taxes and subsidies and all these other issues that these non-tariff barriers that Trump claims creates an unfair playing field for American companies abroad.
Well, I'll tell you, Brendan, even though Scott Bessent isn't where you are at the G20 finance ministers meeting in Cape Town, they are still giving them plenty to talk about. Brendan, thank you so much for joining us. Brendan Murray in Cape Town of Bloomberg. Staying on trade, Paul Donovan of UBS writes on the apparent confusion for this timeline on implementing Mexican and Canadian tariffs, saying, quote, "Such taxes would be very visible to U.S. consumers at a time when Trump's approval rating on the economy and inflation have fallen, making repeated retreats likely." I am pleased to say that Paul joins us now, chief economist at UBS Global Wealth Management. Paul, it is so great to see you. And first, let me apologize on Manas's behalf, because he's always very sad when he misses you, but don't feel bad for him. He's taking some much needed time off. Paul, on this point, because it is a market that continues to discount when tariffs might happen or that they will happen, do you discount it as well? Is this more bark than bite?
So I think we've got to distinguish between the visible tariffs and the less visible, sometimes invisible tariffs. So if President Trump goes ahead and taxes U.S. consumers of avocados by 25%, which is what a Mexican tariff would be, then Gen Z's going to riot in the streets because avocado on toast suddenly shoots up in price. That's very, very visible, and it's very notable, I think, that the four big retreats that Trump has made on Colombia, Mexico, Canada, and the de minimis tariff, these are all very visible to the consumer, and Trump has just backed away, sometimes within hours of making the threat. Now, if we're talking about something like steel and aluminium, that's a lot less visible to the end consumer. The retail consumer doesn't pop down to Walmart for a bar of aluminium. They might pop down for a six-pack of beer, but a 25% tax on U.S. consumers of aluminium would raise the price of a six-pack of beer by about 1.5 cents. I've done the maths on this. So that's not something that's going to be very visible. And those tariffs, therefore, I think are more likely to endure.
Yeah, fair enough. The only metal that people are going to pop down to Walmart to buy is maybe gold at this point, Paul. But to that point, How do you evaluate the impact of tariffs? And let's set aside the actual tariffs themselves, just the threat and the continued timeline. If you think about a business that maybe is saying, let me pull forward my orders, or maybe let me cancel my orders because it seems like the tariffs are going to come later, does that in itself leave scars on the American economy?
It certainly creates quite a lot of disruption. So you've got a number of issues here. The one thing is that you may get, let's pull forward the orders, which obviously will be a support for growth, but then you get a tailing off. There is some evidence that Democrat voting consumers also brought forward some of their consumption ahead of the Trump presidency, though it would appear, at least from rather dubious survey evidence, that Republicans did not. So you may get some consumer behavior changes. But then there's also the uncertainty. Do you want to invest in the future in building out a plant if you've got no real transparency about what your input costs are going to be in the future? So that's going to be a concern. And I think the final thing that's worthwhile pointing out is that all of this uncertainty, this backwards and forwards, it actually perhaps weakens the ability of the US to strike really good trade deals. Because why would Europe make a concession if they've got no faith that the United States will honor a trade deal made today in a year's time? So there's lots and lots of noise and uncertainty that comes around this.
So put a finer point on this, Paul, then, because you're at this time where some of the survey data, and I know you are the first to say that survey data you should take with a grain of salt because of the political biases in it, but survey data weakening, things like PMIs looking a bit more rough than expected. Is that the trajectory here? Are we headed for something that looks like economic weakness?
So I think that the combination of tariff uncertainty and the less efficient US government, the fact that if your supply chain touches the US government at any point, you may not have a counterpart to deal with. Those things are likely to slow growth this year. So that, I think, is something we're going to be seeing. Now, are the surveys telling us anything useful? Honestly, I don't really think so, because businesses know that if they shout about how terrible everything is, it might help change policy. So there's a certain amount of gamesmanship here. You want to say things are absolutely terrible in the hope that politicians will then react not to the reality, but to the noise that you're making. So I wouldn't read too much into the exact survey levels, but I do think that this uncertainty combined with some of the disruption on the government side is likely to lead to a slowdown in growth in the States this year.
Do businesses making noise move the dial, Paul, as long as 10-year yields are under control? Because this is a White House, this is a U.S. Treasury Secretary that has explicitly said that this is the barometer that they're looking at to make sure that yields stay in check and they don't unduly move higher.
So I think it can move the dial because, of course, it's not just the White House that we're talking about. I mean, one way of getting 10-year yields down is to have a recession. I am not suggesting that the US goes into recession, but if you start to see economic weakness, the 10-year yield is very benign, but then members of Congress are, hearing from their constituents, if they do actually hold town halls or if they open the mail, that things are bad and we're not going to vote for you at the midterms and so on. And that then means that members of Congress start to apply pressure to the administration and say, actually, you know what, this is going to be a problem if we don't resolve it. So there are different channels in which a slowdown would have an impact, I suspect.
Paul, such an important conversation. We always appreciate your excellent insight. Paul Donovan of UBS Global Wealth Management. This is Bloomberg.
the dirty little secrets of credit is that the businesses generally don't pay you back, right? The markets pay you back, M&A pays you back. So what is the most important thing is to always make sure that the borrower is worth more than the loan. And as long as the borrower is worth more than the loan, then it might be a rocky ride, but you're going to get your money back. And this world where there's these disruptive companies that have, let's call it 100, 200, 300 million of ARR, are looking to not raise equity capital because of the fact that they raised it in 2021 or 2022, and no one really wants a down round. But there's a lot of capacity in the capital structure to have, let's call it a structured solution. We think that there's a lot of opportunity with those businesses.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Take a look at the front pages this morning. First up, the New York Times leading with Supreme Court Chief Justice John Roberts temporarily letting President Trump keep his freezing of foreign aid payments. The block comes after a U.S. district judge's order that would have required payments to be made by just before midnight tonight. Humanitarian groups say that the freeze is having a devastating impact, upending hundreds of projects. Next up, Bloomberg has this. Secretary of State Marco Rubio stated that the U.S. wants to dilute Russia's close relationship with China without causing division. Rubio warned that if Russia becomes too dependent on China, it could pose a problem for the U.S. Next up on your front pages this morning, away from that China story, the Wall Street Journal has President Trump revoking a Biden-era license that allowed Chevron to produce oil in Venezuela. Trump cited the electoral conditions in Venezuela and the country's failure to take back migrants from the U.S. as quickly as it promised. Coming up in the show, we revisit NVIDIA earnings, shares up 0.5% just about. We're also going to be catching up with Priya Misra of JP Morgan Asset Management. This is Bloomberg.
In 2000, post-Napster, generally everybody wrote off the recorded music industry, including the investment community. And I didn't mind that chapter because then I got left alone. And actually, I think out of that period, we started to create better art because the pressure wasn't on from the technology to be the most powerful chapter. And then iTunes came in, and iTunes, to Apple's credit, did have a boutique taste mentality about the store, which meant that I think they understood. I can tell you from that period that the artists that came through were of a very high quality because it was encouraged to be boutique. Now, ironically, this chapter has made us more money times 5 than the iTunes chapter and the post-Napster chapter. But an algorithm tells you what you want, not what you might like. And there's a difference between what you want, but with streaming, the downside is you have incredible penetration, and we have hundreds of millions of people around the world. And so that has been very lucrative as a business.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Global headquarters in New York. Welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. Good but not great. NVIDIA warns of tighter margins as Blackwell production and trade risks loom. Tariff confusion, President Trump's contradicting comments, and a vow for European levies weigh on the region's equity market. And after 6 days of decline, Treasury yields do push higher today. We get jobless claims and a marathon of Fed speak. Let's take you to the one stock that you probably wake up and want to check this morning. NVIDIA, now at the highs of the pre-market session, up 1.2%. It ended the post-market session lower yesterday, so it is remarkable that it was able to stage a turnaround sufficiently ahead of Wall Street's estimates, I suppose, keeping it flat to higher. Catch your breath, maybe forget about DeepSeek for a little bit. That seems to be the trade. Overall, equity futures are also moving higher. It is an outperformance for the NASDAQ relative to the S&P. Both are up more than 0.5%. Russell 2000 futures up 0.7%. European equities, after hitting a new all-time high yesterday, they fall by 0.4 with a new threat of 25% tariffs from President Trump. The market finally listening to one of the threats. Treasuries this morning, again, as I said, they fell for a 6th consecutive session yesterday. That's the longest losing streak since September of last year. 10s are still around the lowest since December 10th, but we do get a move higher this morning. 5 basis points for your 10-year yield. We are at 4.3%. Now, among the comments that President Trump made during his first cabinet meeting on Wednesday was his continued push for federal cuts led by Doge. Take a listen to that.
One of the most important initiatives is Doge, and we have cut billions and billions and billions of dollars. We're looking to get it maybe to $1 trillion. If we can do that, we're going to start getting to be at a point where we can think in terms of balancing budgets, believe it or not, something you haven't heard in many, many years, decades actually.
The administration is looking to save trillions, they say, while House Republicans passed the president's budget blueprint earlier this week, paving the way for a possible tax cut. JP Morgan's Priya Misra weighs in, writing, quote, "There's a growing appreciation that despite what President Trump said on the campaign trail, it will be very difficult to get any tax cuts beyond the 2017 tax cut extension. Bond vigilantes can rest easy, and resting easy they have." Pleased to say that Priya joins us now. Priya, thanks so much for joining. It's really great to see you.
Thanks for having me.
Look, since roughly the start of the year, bond yields in the 10-year have fallen by about 50 basis points. And there seems to be two narratives as to why. One is the cooling economic data. The other is kind of what you've pointed to, this administration's desire to keep a cap on 10-year yields. What do you see as the driving force behind bonds this year?
I think it is both. The cooling economic data, I think, takes this re-acceleration theme off the table. I think there was concern with the inflation data being a little bumpy, a little sticky. That is the economy about to re-accelerate? And some of the animal spirits post-election, I think there was an expectation, does that result in more investment, higher growth? I think we've taken that off. You're seeing that growth. I would argue we're still in a soft landing. We're seeing bumpy economic data. We'll see initial, but look at initial claims. We're going to get that data today. Layoffs are still extremely low. The job market is strong. The consumer is spending. There's uncertainty weighing, and the longer it lasts, it'll make me a little nervous about the, this might actually impact investment lower. But I think we've taken that off. But I like that you bring up the tax side, because I think the market constraint, the debt constraint, the inflation constraint, that was all clear when Secretary Bessent as well as President Trump said we care about the 10-year. And that's why the long end has been moving lower. So I think the front end is more about that extent, the acceleration taken off. The fact that the long end is moving is this idea that, you know, there is a debt issue. The debt trajectory is a problem. And so if the administration, some combination of DOGE as well as spending cuts, the House bill has $2 trillion of spending cuts. I don't know politically if we're going to be able to get that done. But I think that just tells you that the Congress, the administration understand that the market cannot take a whole lot of tax cuts. And $7 trillion was the total impact on the deficit of everything that was promised. I think all we're going to get is that 2017 tax cut. So the market's getting a little less worried about this runaway debt trajectory.
So the market is less worried, but there were some who say that you started to see kind of a growth scare start to creep in with some of the softer data. Just to kind of emphasize the point you're making, is this not a growth scare, but more of just a normalization of expectations, pulling back from this huge reignition of growth because of the president's policies?
So we have seen a little bit of softer, I would say, survey data. The hard data is still pretty strong. Look at that, and we're going to get a payroll report next week, so we'll see the job data, the spending data is still strong. I think it's the distribution that's shifted. The tail risk was re-acceleration. Maybe the Fed needs to hike. Remember that talk? And now it's, well, maybe they need to cut. I also think it's interesting what we heard from the Fed, that there's an asymmetry there. They're not talking about hikes. Even the ones that are concerned about inflation being sticky are saying we might stay on hold, but if things slow down, we're going to cut. So I think as the market reassesses that distribution and says maybe the downside risks are higher. So I think that, yes, if we continue to see weaker data, I think that tail risk of weaker growth picks up and we start to price in more Fed cuts because they're telling us that they will be responsive.
Just listening to you speak, I'm really struck by how the consensus at the end of each year, be it last year, the year before that, for bonds, just feels like it's been wrong every single year. And to start this year, it was yields are moving higher. We're going to get inflationary policy. But bonds have been working, to your point, when equities have fallen. How hard has it been to convince clients of that they should be in this treasury market?
So I think some clients get it. We're seeing significant inflows into bond funds. I mean, cash has felt good when you're getting 4% on cash. You know that money is safe and you're earning 4%, which is actually above inflation. So people say, I'm getting positive real rates. High quality spread product is giving you 6%. If you can go into high yield, you're getting 7%. So we are seeing inflows. I think people who are saying equities have had a great run, maybe I take some chips off the table or I take some of my cash and put it in bonds. But there are other people who I think are not looking at the correlation in the last 2 months who are saying, okay, maybe equities don't go up 25% every year. And so if I do want to keep some powder dry, or I want to take some risk off, I'm moving to cash. And it's to those that I would highlight DeepSeek Monday, Tariff Tuesday. I need something for Wednesday, or maybe new home sales Wednesday. You look at these days where you get, whether it's uncertainty, whether it's, there was that COVID headline on Friday.
Yeah.
Any headline that pushes risk assets lower, actually bond yields, treasury rates are moving lower. So I think rather than looking at the 2-year correlation, I mean, in 2022, there was no correlation. The correlation was opposite because the Fed was hiking. Unless we talk about Fed hikes, I would argue that correlations are here to stay. So for people who are getting nervous about the stock market moves, actually bonds will allow you to stay invested in stocks because this is an asset class which will make money if risk assets underperform. I think as people see that, I hope that they'll then say, well, I'm getting yield and I'm getting diversification. Both of those were missing in fixed income for a 20-year period. And I think that's why people have been underinvested in fixed income. Some are seeing it, and that's why I think you're seeing the inflows. But I think that $7 trillion in cash tells me that there's still a lot of people who want to see these correlations continue, but rates are moving lower. So you've missed out a little bit if you have not been buying fixed income. You're still at 4.3 on the 10-year. I think given where Fed funds is, we think the Fed's going to cut a few more times. I think that 10-year is going to move lower, closer to 4%. And if you get a recession or slowdown and the Fed's cutting more, that 10-year can move a lot lower.
What do you make, though, that whole dynamic is unfolding? Bonds are working. Equities are having days like DeepSeek Monday and whatever we decide Wednesday is called. But spreads on credit are still so tight. They're unmoved. What do you make of that?
So they're tight, but I would say for good reason. Look at corporate fundamentals. They're strong, earnings are strong. Now, do they justify all the PE multiples? I'm not an equity expert. We can debate that. But do they justify not earning that much more in spread? So I agree, spreads historically are tight, but I would say they reflect very solid corporate balance sheets. We look at what are companies doing with the debt they're issuing. Are they re-levering up? That would make me nervous about spreads. They're not. A lot of them are just reissuing what is maturing. So leverage is not picking up. So spreads are tight. People are looking at all-in yields. If you're getting 6-7%, that's why it looks attractive. I think that's why we're continuing to see supply, and there's been a lot of supply. First quarter typically has a lot of corporate supply. It's all been taken down well. New issue concessions have been tight. I think it's that all-in, the yield argument has won out over that spread argument.
Priya, we're going to have to leave it there. It is always so fantastic to have you on. And what a relief. Bonds are working again. I'm sure a lot of people are happy about that. Priya, thank you so much. That's Priya Misra of JP Morgan. Coming up on the show, NVIDIA bounces back after an initial muted response from their earnings. We're going to unpack the results of Frank Lee of HSBC. Coming up next on Your Brief.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
In case you missed it, from Bloomberg's coverage at Davos.
Do you think there's one particular thing that you'd like Trump to change in terms of what some people see as the over-regulation of banking in America?
I don't believe, honestly, that we should have a huge amount of deregulation for larger banks. I think that's, you look back at COVID and any crisis, big banks now are strong, are able to step in and being part of resolving issues rather than being the one that creates issues. So I wouldn't really welcome a huge wave of the regulations. What I can see is that, of course, what happened in the US doesn't mean automatically that you will see in Europe or in Switzerland or in Asia deregulation. So the fact is that US banks may become even more competitive internationally through a more benign environment.
Nobody covers Davos like Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Tariffs, at this point, it's a little bit of an unknown. It's an unknown until we understand further what the U.S. government's plan is, both its timing, its where, and how much. So at this time, we are awaiting. But again, we would, of course, always follow export controls and or tariffs in that manner.
One of many comments we heard on the NVIDIA earnings call, that was the CFO on the complex trade landscape that the chip giant has to navigate. The stock is trading higher in the pre-market trade, about 1 1/3%. It did end the post-market trade lower yesterday, so it has been a ride. Joining us on that ride is Frank Lee, Global Head of Tech, Hardware, and Semi-Research at HSBC. Frank has a buy rating on the stock and a price target of $175. Frank, the market seems to be changing its mind within the span of a couple of hours, how it feels about the earnings. What did you take away from the NVIDIA results?
Yeah, so I think the results themselves were strong and solid, but the question is whether or not
it was good enough for the market to see a significant beat and raise. It's been 2 quarters now where you haven't really seen a significant beat and raise after the results. There were some positives. I think the Blackwell revenue that came in at 11 billion was a lot higher than I think we were looking for, as well as the street. But at the same time, when you look at the guidance, the forward-looking guidance of 43 billion, you're talking about a net increase of about 4 billion. But the Blackwell revenue is probably better than people expect by 5 or 6 billion. So that suggests that you're probably going to see some drop off on the Hopper. And so I think, it was a good number, but it may not be enough for people to continue to take their numbers up much higher from where we are.
Well, people are and got really used to, Frank, this idea of a really big beat and raise, to your point. Are we now witnessing a period of more normalized growth for NVIDIA, or do they have something coming forward that will reignite that massive growth cycle?
Yeah, so great question. I think, one of the things that really drove NVIDIA share price for the first year and a half of this AI cycle was just their pricing power that they got, starting with the beginning of AI when they moved into the Hopper, and then you had the Blackwell, and then most recently was last year when you actually had the introduction of this idea of a rack server that would significantly boost their ASPs. But we haven't really seen anything that is raising that ASP much higher from here. It doesn't mean to say that that's not going to happen. So I think a lot of focus will be on GTC in terms of what their roadmap looks like going forward, and whether that can continue to drive pricing even higher, and we get back to that cycle. And I also think the other thing that the companies talked about is, especially Jensen's talked about autos and also robotic demand. Those are interesting TAM areas, but at the moment they're still quite small. So, we haven't seen much of a revenue contribution, but those are going to be areas I think people are going to be looking at quite closely going forward.
One of the other things that came from the earning was Jensen Huang talking about the immense computing power that's going to happen going forward, that once you get these AM models that are doing more reasoning versus the one-shot prompts, as he calls them, that you're going to need more power. He talked about something like 100 times greater than what we have at this moment. I mean, these are numbers that are difficult for our tiny little human brains to comprehend, Frank, but they also come off the back of this DeepSeek freakout. Do you think that these earnings highlighted that we were a little bit too worried on the actual ramifications of DeepSeek, or is it just a delayed impact from it?
Yeah, so again, I think it's a good point. I mean, the DeepSeek initial reaction, I think, was a bit I think the concern was that would it change the AI CapEx trajectory, given all the spend that we've seen from hyperscalers? Well, the answer was pretty clear in this earnings season. The hyperscalers not only did not cut their CapEx, they actually, most of them raised it. So that basically, I think, gave the market a bit of confidence again that the demand outlook, at least through this year, is fine. That being said, it does raise some longer-term headwinds. Is there going to be some impact on demand long-term? There's the threat of ASIC, especially Broadcom and Marvell has become a big focus now in AI semis, and also I think the export controls. So you've got a few headwinds. They're not anything that's going to really impact NVIDIA earnings in the near term, but it's a longer-term outlook. So I think that's why NVIDIA needs to really regain its earnings momentum, either through better pricing or perhaps more focus on these new TAM areas that we've talked about.
Well, here's something else that might be concerning when it comes to their ability to ramp margins back up, Frank. Before we brought you in, we had these comments from the CFO that tariffs at this point, it's a little bit of an unknown. It's an unknown until we understand further what the U.S. government's plan is, both its timing, its where, and how much. Frank, how are you understanding the tariff threat and what it could mean for NVIDIA?
Yeah, it is a very difficult one to answer because a tariff will impact everybody. So I think ultimately it will just get passed through to the hyperscalers, to the people funding it. And then you're in an environment where costs go up, and then you do have DeepSeek potentially come in as a lower cost option. So those are going to be remaining headwinds. The company has guided margins to come back up in the back half of the year from where we are, which is pretty much around 70%. So that does show that there is some improvement on the way up. But again, you're right, there is going to be some headwinds. So we think the earnings is fine, but the headwinds stay there, and that's why I think the multiple hasn't really moved up.
Frank, I was just looking through some of the companies you cover. I know you have a buy of NVIDIA. It seems like you have either a hold or reduce on all the other chip-making stocks that you follow. What else do you like in this market besides NVIDIA?
Well, I think, the other name that we like quite a bit is, the TSMC. We know there's been some headlines about tariff issues hitting them, but really they're the only game in town. So, every single chip maker has to depend on them, whether it's the ASIC trend, they were still going to go through TSMC. So we think this is a company that's very well positioned in the long run where there's no immediate challengers. We don't see any real threat from Samsung, and Intel right now, I think, is struggling to try to figure out what to do with its foundry business.
Frank, we really appreciate you joining this morning. I know it's been a busy past 24 hours for you. Frank Lee of HSBC there. Now on to a Bloomberg scoop. Sources say that Nissan is drawing up plans to replace its CEO after earnings disappointed and in the wake of the collapse of the deal talks with Honda. Joining us for more is Craig Trudell, who leads Bloomberg's global automotive coverage. Craig, Honda wanted the CEO out. Now it seems Nissan does too. Is this now just inevitable?
I think the writing is on the wall here. When you look at the way Nissan's been performing, you mentioned the reports that Honda was potentially open to resuming talks with Nissan, assuming Uchida were to leave. I think Uchida himself, addressed this with reporters just in the last couple of weeks and said, essentially that he would not hold on to this role, that he was willing to relinquish it, but that he wanted to stabilize the company first. I think the problem for him is just how much things have been going against him, how dramatically Nissan's earnings have shifted. 9 months ago, this was a company that was expecting 380 billion yen of net profit. It's now projecting an 80 billion yen loss for the fiscal year. So things have really just deteriorated for this company, and it does seem as though his days are numbered.
Craig, elsewhere, we had Trump talking about 25% tariffs for Europe. He basically said everywhere, but he specifically called out autos. We know that this is something that Trump has talked about repeatedly, and we finally are getting some reaction from the equity market in Europe this morning. Does this tariff threat seem real, or is it real enough that it could change the behavior of European auto companies?
I think it's a sort of worst case scenario because you both don't know for sure whether it's real and yet have to be terrified by how disruptive it could be to your business, and you just don't know when it might take effect, to what degree. And, it mixed in with those comments last night from Trump, of course, were, comments about North America and the idea that Mexico and Canada tariffs got pushed back roughly a month yet again. So, on one hand, you can look at that and maybe be encouraged that this is all sort of a negotiating tactic, that he's, kind of saber rattling, if you will. But I think for the European car makers, they know full well that this has been a bugaboo of his, that he's talked about how many Mercedes he sees on Fifth Avenue versus, Cadillacs that you see in Berlin or pick a place in Europe. I think another big challenge is there's not really a sort of, way to credibly offer a more sort of equal trading relationship when, some of the biggest car makers in the U.S. either are pretty much absent from Europe or have been shrinking quite a bit and have local production in Europe and don't necessarily need U.S. imports given the way their sales have been trending.
Yeah, Craig, fair enough. I mean, how many times have we heard Trump recount that story of him speaking with Angela Merkel and bringing up exactly what you say, the cars on the U.S. versus European roads? Craig, thank you so much. As always, that's Bloomberg's Craig Trudell. Just want to bring you a chart that just was published by the AAII survey of individual investors, because it has cratered off. The net bearishness is now at 40%. The number of investors who say that they're bullish has now reached 60%. That is the most bearish we have seen this survey since 2022. So more than 2 years at this point, we are looking at the most bearish level of investors. It's just another sentiment piece showing some of the dour attitude at this moment, but it's remarkable to see where the money is flowing. It is coming out of U.S. equities, and it is going into European and international equities. Okay, coming up, we are going to set you up for your trading day. For you, the bears among there, the UK Prime Minister Starmer will be visiting the White House. We also have more earnings on deck. That's coming up next on your brief.
is back. Join me, Shonali Basak, and the industry's most influential people for a comprehensive view across financial markets. Hear what a second Donald Trump presidency means for the economy, how AI is being monetized by investors, and the next big risks facing the private credit industry. Bloomberg Invest, March 4th and 5th in New York City. Register your interest to attend at bloomberglive.com/invest.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Versace in Davos, Switzerland, and this is Bloomberg.
Let's get you set up for your trading day on this Thursday. We're going to have jobless claims and durable good orders at 8:30 a.m. Eastern. Those jobless claims taking more importance with the Doge cuts. We're also going to get a host of Fed speak. We'll hear from Schmid, Barr, Bowman, Hammack, and Harker all on deck. And we're going to get more tech earnings from Dell and HP after the market close. Plus, UK Prime Minister Keir Starmer will be meeting with the president at the White House later today. Let's quickly whip through some pre-market movers. Salesforce extending post-earnings drag, weaker than expected outlook. Those shares down 4%. eBay down 7.5%. Also a lackluster sales forecast due to soft demand in Germany and the UK. Finally, ending with Moderna. Not an earnings mover here. It is down 3.75%. U.S. health officials are said to be reevaluating funds for bird flu shots that the Biden administration had awarded to Moderna. All right, that is it for your Bloomberg Brief this morning. Surveillance takes it from here.
What about quantum computing? People talk about that. Is that something that I should be looking at investing in?
I've made a lot of mistakes, betting on these new technologies like AR, VR turns out to be not so big, 3D printing turns out to be not so big. My estimate is $100 trillion was invested in today's dollar in the PC, CPU-based infrastructure. All this is going to get ripped out to put $100 trillion or more in our GPU-based infrastructure. In that sort of quantum of numbers, I feel that the quantum computing is going to be very small.
You always are worried about, I presume, geopolitical events. So are there some geopolitical events you're worried about right now?
Yes. I don't know why, but for some reason, I love thinking about black swans. And at the office, everybody thinks I'm weird because I'm always thinking about what can go wrong. But underpinning the AI is the chips. And the chips, despite the CHIP Act, which I think was a good idea for the US, I still think like 80% or so of the capex of TSM is in Taiwan. And so at the leading edge, a lot of capacity is in one very small area. Forget that it's just in China, it's in a very small area. I think that's very risky.
Bloomberg brings you breaking news 24 hours a day, powered by 2,900 journalists and analysts in more than 150 offices across the globe. Bloomberg Television. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
The market's paying up for quality. And so it's back to stock picking, it's back to factor selection.
We are so dependent on these, large index stock flows. If you start seeing outflows from that, it's going to hit those big, Mag 7.
If we don't have earnings moving up in a meaningful way, it's hard to say we're going to have a big upside to the overall market.
We had high expectations for big market and economy impacts, so we're seeing a slower on-ramp for that.
When you look under the hood, there's rotation happening, and that's what's dampening volatility.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Thursday, just about snapping a 4-day losing streak on the S&P 500. Equity futures this morning with a bounce. Here are the scores. On the S&P 500 up by 0.6%. On the NASDAQ 100 up by 0.63. The main event, one stock, a single name. It's NVIDIA in the pre-market with the tiniest of bounces. We're up by 0.98%. Jensen Huang says demand for Blackwell is amazing. The street calls it underwhelming.
Well, amazing isn't insane, so can we really say that it's really that exciting? I mean, this comes down to the nuance of how expensive it is to make some of these chips at a time where there is a lot of competition growing elsewhere. This was all around a great report, right? There were a lot of signs that, yes, it was a beat and a raise once again. Sales guidance was a little above what people expected, but it was the smallest revenue beat in about 2 years. And costs, operating margins coming down, and that, I think, is the focus.
That's the earnings. The next stop is the economic data later on this morning, 8:30 Eastern Time. Jobless claims. Why are jobless claims so important? They're becoming more important following the cuts we're about to see down in Washington, D.C.
So there are two things that people are going to be using the jobless claims for. The first is going to be to signal just how steep some of the DOGE cuts have been, how concentrated they are in specific states. Imagine a lot of state-by-state dissection of just what these details show. And then you layer on top of it this idea that we just saw this huge growth scare, really reprice cuts, Fed cuts into the market. Do you get confirmation of that with jobless claims going up or not? Do you get sort of a rebuttal of that with the idea that we're still in this pretty calm place?
With some confusion around the tariff story, Anne-Marie's down in Washington, D.C. this morning. You'll see plenty of her in the nation's capital. These are the proposals. We keep going to the calendar. Let's go to the calendar once again. So on March 4th, next week, 25% tariffs on Canada and Mexico. In the middle of March, we're talking about 25% tariffs on steel and aluminum. Then in early April, the reciprocal tariffs. The EU might be in trouble. Then yesterday, some confusion. Is Canada and Mexico next week or the following month?
So Donald Trump, President Trump, suggested that maybe it was April 2nd that the Canada and Mexico tariffs would go on versus the March 4th that previously thought. The White House came out and said, no, March 4th is still the time. That I don't know where the confusion is coming into play, but we still have the deadline. So the market immediately priced in the idea that we were pushing back or maybe never going to get the Canada and Mexico tariffs. And the White House is still throwing out that maybe that's the case. But it just highlights the uncertainty and the lack of conviction and, frankly, just how much this market is not pricing in the likelihood of Canada and Mexico tariffs actually going on.
Speaks to some of the inertia that you're seeing in the business community right now and for consumers alike. Equity futures right now on the S&P positive by 0.6%. Your lineup through the next 60 minutes looks like this. We'll catch up with Chris Ferrone of Strategas, a stock snap, a 4-day losing streak. Terry Haynes of Pangea Policy on President Trump's EU tariff threat, and Torsten Slock of Apollo as the Doge cuts deepen. We begin this hour with stocks higher as markets digest NVIDIA earnings and a little bit of confusion on the tariff front. Chris Ferrone of Strategas, a Baird company, writing, for all the concerns about tariff policy, the market still seems more worried about growth than inflation. Chris joins us now for more. Chris, good morning.
It's great to be here, John.
Kept going over your quote from the last time we spoke.
Yeah.
Do lower yields speak to some kind of economic weakness, or do they support cyclicality in the equity market? Is the equity market answering that question now?
Well, yeah, I think that's what's been so important about this move lower in yields over the last month or so, is it has not recatalyzed the leadership from the market's more cyclical corners. I think it's a very big change in the character of what we've seen, frankly, over the last 18 months, where when you would get relief in yields, you would re-entertain this broadening of the market, this cyclical or small cap leadership, and you just have not seen that here to any great extent. So what we ask is, are lower yields actually more reflective of maybe something sinister with the economy moving forward? And listen, I think the jury's still out on that. Financials are still pretty good here. Credit's still relatively calm, but it would be silly not to even entertain that here.
Does credit confirm? Was going to be the next question. What do you see in credit in high yield, in the more speculative parts of fixed income?
It's still remarkably benign here. That's why I don't want to get too over my skis or too carried away with the growth scare call or the markets putting in some big top call, because at the end of the day, if something really sinister is out there, you're going to see it through the lens of where you typically see it. Weaker financials, weaker banks, weaker credit. And we can't check those boxes yet. So we're alert here. We put out a note last week, some reasons for caution. I just don't want to get too over my skis with that view yet until you begin to see changes in financials and credit, which you have not gotten yet.
Is there a larger takeaway here? And John was laughing at me the other day when I said, actually, if you get a good auction, that could be a bad thing too right now. And he's like, it's a bad auction, it's terrible. If it's a good auction, it's terrible. How much more bearish can you get? But is it telling of where valuations are in risk assets that a rally into bonds could be viewed more for the negative? And if you get a sell-off in bonds, that also could be some sort of hit to valuations at these levels.
Well, I'll make a couple points. I think, Lisa, what you described there is simply a game of expectations. And I think we entered 2025 with the expectations game very full domestically and very light elsewhere. And what have we seen to start the year here? We've seen Europe and China, I think, easily exceed low expectations, while we've struggled here domestically to kind of meet the bar of high valuation, maybe deteriorating technicals, and all the like. So that expectations juxtaposition was really, I thought, the crux going into 25, and I think it remains one going forward. When you look at the inflation impetus behind tariffs or immigration, the places where I would expect to see it, higher bond yields, you're just not seeing it. So again, it comes back to the question, maybe the market has more growth concerns on its mind than it does inflation. One last big point here. While we've seen cyclicality weaken domestically, I think it's important that we have not seen that elsewhere. Cyclicality has not been extinguished globally. I mean, cyclicality is alive and well in Europe. It's really alive and well in Asia and China here. So it seems like, if anything, cyclicality has just migrated to other parts of the world. What do Europe and China have in common? They have much more accommodative central bankers right now. I think that's the big difference.
I think you nailed it when you started by saying it's been a game of expectations, and a lot of this is just simply the money moving to places where it seems that evaluations maybe are a little less extreme. Have we already overdone that? I mean, is that basically what we've seen to date? And now any further decline in yields, any further deterioration in equities has to come on true evidence of really true weakness in the U.S. versus just simply a rejiggering of capital flows.
You know, I think we sit here, 10-year yields went out at 425 yesterday. They're maybe 430 this morning. The 2-year average in yields is right about here, about 420. So basically, the last 2 years, you've made no progress. For as much as you want to take credit for yields lower here, the reality is no one's really made any money on either side. It's been a range. So I think at the end of the day, where's the bottom end of that range? Somewhere around 390, 380. I think underneath that, then you'd really begin to say, whoa, wait a second. What is the market really messaging about the economy here? So I think we're okay here. I think we're in some range. The market's digesting these expectations. What we don't want to see is the internals get any worse. We're sitting here with 60, 65% of stocks above the 200-day moving average. Don't want to see that much under 50%. That turns a split market into a bad market.
What you described, though, at the equity level, Europe versus the United States, China versus the United States, is also taking place at the fixed income level, which I find really interesting. We closed out last year, and 10-year government bond yields in America are climbing. In China, they're cratering. They're rolling over aggressively. And if you look at the charts to start the year, it's like we flipped. What explains that story?
Yeah, I think really important change there. And, you know, we've been very much in this camp that what was beginning to play out in China over the last year was very reflective of what 2008, 2009 looked like here domestically, where you were in this financial crisis and you just couldn't get stabilization until particularly the short end of the bond market stabilized. We've now seen that in China. I mean, 2-year yields in China are up 50, 55 basis points over the last 5 or 6 weeks. I think that is essential to really changing the tide and changing the narrative. Remember, you've had these kind of fits and starts of rallies in China over the last year, but this is the first one where bond yields have actually gone up. That, I think, is a really important change. Also, look at the leadership in China. Discretionary is trouncing staples. Financials have broken out. Tech and semis are your leadership. It is a really clean leadership setup in China. I think it's suggestive of the market saying we're past the worst of the economic recession there.
It's a massive sentiment shift backed up by higher bond yields. Stateside, we've got this big dislocation going on in the equity market. The Mag 7 down 10% from all-time highs in December. What do you and the team tell clients to do with that now? What's the approach to tech?
So when you kind of take them one by one, and I'll say this as someone who's not a particularly level-sensitive investor or analyst. I like to think more about the character of a market or what the leadership looks like. But I think this is a year where you do have to be very level-sensitive because this Mag 7 is not monolithic anymore. And you look at Nvidia up modestly after what seemed like good numbers. That always raises an eyebrow to me when you can't respond to good numbers. But the reality is, it's a stock that's been dead money for 7 or 8 months. It really has not made a new high since about June. I mean, there was a fractional new high late last year, but really has not made a new high since June. I think as long as that's under 140, 144, it's probably the same story, kind of dead money here. When you look at Mag 7 or just large cap tech broadly, I think the other big story, though, is it peaked relative to the S&P the exact same day that dollar-yen peaked, July 10th of 2024. So to think these two things are not related, I think, would be silly. What's been a bigger driver of flow, east to west, than yen carry over the last decade? So to the degree that's changed, I think it's important.
That's exactly where I wanted to go. And how much is this in tandem with the fact that the dollar's weakened versus strengthened so far? How much do you see a stickiness to that reversal in flows? This idea that countries that used to be huge investors in the U.S. suddenly are seeing more to favor at home?
Yeah, I mean, what's the first rule that you learn in this business is capital goes where capital is treated best. And I think for a long time, when the interest rate was fixed or suppressed, that rule was thrown out the window. That rule's back. And the fact that, I mean, look at Japanese 2-year yields or Japanese 10-year yields, I think they tell you the whole story. We're going to get more from the BOJ. I think the BOJ is going to surprise on the hawkish side. I think dollar yen is telling us that. But not just dollar yen. Look at every yen pair, right? Sterling yen, Aussie yen, Euro yen, you have put a major, major bottom in yen. So again, what does stronger yen mean going forward? I think less money moving east to west. Where does that impact? Well, what's been the biggest receiver of these flows over the last decade? So I don't think these things are entirely coincident. I do think there's some causality here as well.
We've been building up a dollar long for the best part of a decade plus. Dollar-denominated assets, and part of that story has been big tech and a Mag 7.
And that's the reason why the idea that we're talking about the dollar-yen and how that coheres with the peak that we saw in Magnificent Seven is really important to me. I keep thinking about the credit pockets that the Japanese investors, CLOs, collateralized loan obligations, that Japanese investors are some of the biggest investors in. What does this do to potential dislocations down the pike? Really interesting.
Hey, Chris, smart as always. You're one of the best. Appreciate it. Chris Ferrone there of Strategas, a bad company. Dollar yen this morning, 149.80. With an update on stories elsewhere this morning, here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. At his first cabinet meeting, President Donald Trump gave conflicting messages on the future of tariffs. The president said that tariffs on Canada and Mexico would go into effect in April instead of the March deadline. White House officials later clarified that the deadline, though, does remain next week. Trump also proposed 25% tariffs on the EU without further details. A check on shares of NVIDIA. They are higher by 1% in the pre-market after initially trading flat. Earnings beat analyst estimates. Gross profit, though, that will be tighter than expected as it rolls out its new Blackwell chip. Those results amid concerns about whether AI capex would slow and the potential impact of U.S. tariffs. Amazon's cloud unit has built its first quantum computing chip, joining the likes of Alphabet and Microsoft in reaching the computing milestone. The hope is that quantum chips will lead to advancements in fields like chemistry and healthcare. Amazon Web Services named the new chip Ocelot, referring to its oscillators. And coming up, 11 a.m. on B-Tech, an interview with Amazon CEO Andy Jassy. And that's your brief, John.
Danny, thank you. Don't miss that. More from Danny in about 30 minutes' time. Up next on the program, tariff uncertainty.
Mr. President, can you clarify the Canada-Mexico tariffs? You had put that 30-day pause, but you just referred to April.
25%.
25%. When does it go into effect?
April 2nd.
April 2nd for Canada-Mexico.
Correct. And for everything.
So is it March or is it April? We'll try and get you some clarity in just a moment with Terry Haynes of Pangea Policy, live from New York City this morning. Good morning.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Equity futures on the S&P 500 up here by 0.6%. Check out the bond market. Yields bouncing back by 5 basis points. We've had quite a run of lower yields. We'll talk more about that later in the program. The 10-year right now, 430.77. Under surveillance this morning, tariff uncertainty.
Mr. President, can you clarify the Canada-Mexico tariffs? You had put that 30-day pause, but you just referred to April.
25%.
25%. When does it go into effect?
April 2nd.
April 2nd for Canada-Mexico.
Correct.
And
for everything. It'll be 25%, generally speaking, and that'll be on cars and all other things. And European Union is a different case than Canada, different kind of case. They've really taken advantage of us in a different way.
So here's the latest this morning. President Trump causing just a little bit of confusion over when tariffs on Canada and Mexico will be enacted. A White House official saying later on Wednesday the deadline for the levies remains March 4th. Anne-Marie joins us now from Washington to attempt to make some sense of all of this. Anne-Marie, how do you make sense of it?
Well, Jonathan, it's confusing, right? Because we also heard from the Commerce Secretary Howard Lutnick yesterday at the cabinet meeting, who seemed to insinuate that there is potentially a path forward for another pause with Canada and Mexico if they were to really come in with solutions to stem the flow of migrants and fentanyl. So we're 5 days away. And like the markets, I am also confused. So here to help us out this morning is a friend of ours, of course, Terry Haynes of Pangea Policy. Terry, great to have you. Great to see you in person. Tell us, should the markets be believing Commerce Secretary Howard Lutnick or Donald Trump right now?
The answer is yes, I think.
Yes to which?
Well, I think the decision has been made. I think they employ strategic ambiguity, a phrase familiar to the Taiwanese, but you know, they think that's part of the deal making, and they will continue to do that for a while. And one reason why I think it's premature is, frankly, is that you've got a situation where they have said all along that they're going to look at reciprocal tariffs and the like in an April timeframe. So I think this is very much kind of flying by the seat of the pants until then.
So even if we get some sort of tariff level next Tuesday, I mean, this is 5 days away. This is just around the corner. Does that mean then the level could rise to 25% for those two trading partners, which are part of the USMCA, by April 2nd?
Yeah, it could rise or it could fall. One of the things that Secretary of Treasury Bessent has been very specific about is talking about the kind of it's a path-dependent decision on a lot of these things. So in this case, the path is dependent on what the other countries actually do in response to what the United States wants.
So choose your own adventure. So
yeah, kind of. Yeah.
So if you're the leader of Mexico or Canada, what kind of concessions are you right now offering this Oval Office?
You want to continue to push on border. You want to continue to show them that you're serious about the border, and you want to continue to show them that you're serious about the flow of illegal drugs, particularly fentanyl, into the country, because that's what the Trump administration says they care about. And you also want to talk to them about autos, frankly, because they will perceive that as a Trump weak spot, but that benefits all countries to be able to figure out how to massage that.
And something already we've heard auto executives like the Ford CEO talking about how this could, quote, blow a hole in the industry.
Exactly.
Trump was also very direct yesterday about the European Union. 25%, he said, are coming on those sectors. What should the European Union be doing right now?
As aggressively as possible, talking to them about ways to mitigate whatever they think the problem is. I think one thing that the United States does not know, that the European Union does not know, is frankly what the United States' interest is, and whether it's purely economic, whether there's some other issue or others. My suspicion is that Trump is using the European Union tariffs as a way to keep the European Union in line on Ukraine, frankly.
When it comes to Europe, there's also the United Kingdom. Keir Starmer is going to be the prime minister in Washington, D.C. today. Joint press conference with the president at 2 p.m., so hopefully we'll learn a lot. But right now in Congress, Democrats and Republicans are reintroducing a bill that's been floating around before in the past to try to get a trade deal done between Washington and London. Do you think this fight Trump is about to have with Brussels can actually help Keir Starmer get this over the finish line?
Oh, yeah, absolutely. The UK very much wants to differentiate itself from Europe in this regard. This is tough for the Labour Party to do, obviously, because they're much more Europhilic in that sense. But the bottom line is that you have Starmer seeing an opportunity, and you have Starmer also being pressured by the Conservative Party, the party out of power, to do a trade deal with the United States at a time when growth in the UK is almost impossible to come by. So it could be a win-win for Starmer, sure.
And the U.S., I believe, has a trade surplus with the United Kingdom. So already, do you think Keir Starmer is being treated potentially differently than, say, the European Union?
Oh, very much so. And Trump has always treated the UK distinctly from the European Union. When Trump first came to office in 2017, it was just after Brexit, recall, and he has always wanted to pump up the special relationship in a variety of different ways, and I think we're about to see economics take center stage here.
Part of the tariff plan, if you look at the entire Trump 2.0 agenda and all its scope, part of the tariff plan is to offset the tax cuts. And there's a fight going on right now between House Republicans and Senate Republicans on how they're going to enact that agenda. And there's this wonky debate over if they cut taxes from current policy versus current law. And potentially, depending on which way they go, it can mean trillions of dollars on paper, or potentially that it's costing no money. Can you explain this flashpoint right now in the debate? Because I think it's really important, but also which way you think they're going to end up going?
Yeah, I've been banging on about this for a while, and it's starting to go public. It's current policy versus current law. Generally speaking, what happens is that these things get scored in Congress as current law. Now, and current law assumes that the tax cuts are going to expire. Current policy assumes the opposite, assumes that that tax cuts are going to continue. So what ends up happening in tax cuts, wonky but very important, is that the tax cuts become much larger and the pay-fors become a lot smaller because of that assumption.
If they cut from current policy, does that mean Trump has this fiscal room to add in more of those tax aims he talked about on the campaign trail?
Yes,
no
absolutely.
Tax on tips, no tax on Social Security, because right now, that is missing from the House plan.
Exactly so. My favorite example of this always is salt, because, of course, it always excites people in the...
Or because I'm from New York, you feel the need to
excites
drop
people in the New York area. But, you know, the salt blows a huge hole in things. But it doesn't blow a huge hole in things if you're going from a current policy baseline. So you get that room, yes.
Can Johnson, though, do current policy and get the fiscal hawks on side to vote for that?
I think he eventually will, yeah, because Trump will pressure them into doing it.
Where else can they get offsets?
they're not going to be able, I think, to get the amount of savings in Medicare and Medicaid that they would like. They look at it as efficiencies that's going to get draped around their necks.
But they said they're not cutting from Medicaid.
Well, they say they're not, but you can cut from the infrastructure of Medicaid, right? I mean, you can assume that there's maybe too much underneath all of it.
But technically, that would be a Medicaid cut.
And which allows the Democrats and others to hang it around Trump's neck, hang it around Republicans' neck. So I think that's going to be a problem. And that's frankly one of the things I think that's driving them towards this current policy baseline.
There's another cloud looming on the horizon, 15 days potentially to a government shutdown. Yeah. Do you think they shut down?
I'm about 40% today, which is high, and I think it's rising for two reasons. You've got three parties involved, Democrats, Republicans, and Trump. Two of those parties get advantage.
Is he on the Republican side?
Well, two of those, I tend to look at him as like a free-roaming vapor more than anything else. But but two of those get advantage from shutdown. Democrats, of course, want to show people that they're against cutting things, the spending cuts, and it allows them to be run against Elon Musk. Trump also can be advantaged by saying, look at what these people want to do. They want to stop government efficiencies. They want to stop what we're trying to do, which on its face is pretty popular. So you might stumble into something, yeah.
So basically, you have the opportunity with a shutdown for either side to maybe spin it.
Yeah.
Spin
it.
Yeah. All right.
But do I think it's disastrous? No.
It's going to be a spin potentially in 15 days. Terry Haynes of Pangea Policy, thank you so much for joining us this morning. John, lots of confusion in Washington, D.C. when it comes to tariffs, and we have all these tariff dates in the diary to pay attention to. We almost forgot, 15 days away. We could be in the middle of a government shutdown.
It's going to be a busy couple of months with that to think about as well. I think we can only think about one thing at a time, and at the moment we're thinking about tariffs. And what it's doing to the economic data, just people pausing, hit and pause. How many times have you seen a phrase, wait and see, from an executive over the past few days?
Yeah, we saw it again last night from Sweetgreen. I mean, again, you have to wonder how much people are making excuses for overall changes to consumer appetite. They want burgers, not salads. And how much is this something else? But yeah, we're hearing this more and more.
Big stock to watch in the pre-market. NVIDIA is up by 0.9%. We'll catch up with Joseph Moore of Morgan Stanley on NVIDIA's good, but not great, earnings report.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Check out the equity market. Equity futures on the S&P 500 up by 0.6%, just about snapping a 4-day run of losses in yesterday's session. The S&P 500 almost totally unchanged at the close. Check out the bond market, just a mix of uncertainty around trade and some weaker than expected economic data, taking 10-year yields lower for 6 consecutive sessions. This morning, higher by 5 basis points. The 10-year Bramo, 430.96.
And in some ways, it's been a gift to Scott Bessent, who takes a look at the 10-year yield every day. And right now, he's gotten what he wants. And guess what? The Treasury Department has had auctions that have been incredibly successful with a huge amount of demand. Question is, how high is the bar for this to continue, given the fact that the economy isn't actually crumbling and people might be feeling bad, but they're still spending? So it becomes a sort of difficult equation where it seems like there needs to be a real re-rating of what the Fed's going to do for there to be more.
The next stop for this conversation, 2 hours away. Jobless claims just around the corner. Look out for that economic data at 8:30 Eastern time. So in the bond market, we've had a run of almost 7 consecutive weeks of falling 10-year bond yields, and that's taken some heat out of the US dollar. Let's check out the dollar against the euro. Euro dollar, a sneak peek things for you, 104.79. DXY, weaker so far for 4 straight weeks, the longest run since September.
And it really goes to what Chris Verone is talking about. How much is this just a reversal of what we saw at the end of last year with flows changing? Capital going where it gets treated best, where suddenly rates are rising in places like Japan, even as you mentioned in China. How much has this story already played out, and how much is this going to be fueled by something that happens in Europe, say, if there is an investment in defense, or, say, on the flip side, if there is evidence of a weakening U.S. economy?
Chris Verone was talking about capital going to where it's treated best. I think there's a difference between capital being pushed away and capital being pulled away. At the moment, I think you can make the argument that capital is being pushed away by the uncertainty around policy in the United States. It can come back once you get some clarity. For it to be pulled away, you want to see better growth in Europe, you want to see better earnings trends, and I'm not sure we can make a really strong case for that just yet.
And I think that's the reason why everybody comes on and they give you a whole laundry list of reasons why you should be uncertain and feel bad about what's going on with U.S. policy and the uncertainty there. Then they say we still prefer U.S. for everything else, and absolutely we will not pull our money out. So it sort of goes to this question of what are people doing versus saying.
Right now, we're selling bonds again. Yields are up by 5 basis points. It's a minor move against the backdrop of a bigger move over the past few weeks. The 10-year at the moment, 430.58. On our radar this morning, President Trump raising more questions than answers on tariffs. Trump saying levies on Mexico and Canada will go into effect on April 2nd, after previously saying March 4th. Trump also proposing 25% tariffs on the EU without further details.
So it raises just more uncertainty around a time frame for tariffs that this market is already largely discounted. And I think it highlights how people have been saying this is a negotiation with these two trading partners and that would be catastrophic to certain industries. Read Detroit, Michigan, and the auto industry. If they were to go through, the fact that President Trump single-handedly shifted it back a month, just sort of doubled down on that. And you can see the Mexican peso really doing really well this year because people are retracing some of their expectations.
I'm going to do something really dangerous and try and read the tea leaves of what happened yesterday.
This is fun.
I might regret this. This is set to take place next week. 25% tariffs on Canada and Mexico. If you were really, really serious about putting 25% tariffs on Canada and Mexico, wouldn't you know the difference between the dates of early March and early April, and how one thing is early April and another thing as early March. Now, maybe you can just say, look, it's been really busy. There was a sense of confusion, and we can clarify things over the next few days. But I would have thought if this administration was really, really serious about putting 25% tariffs on Mexico and Canada, they'd all be on the same page about when that's going to happen.
Wow, you really went out on a limb. I think everyone agrees with you 100% in markets and beyond, and that's the reason why you're seeing the response that you are. It goes back to, what are they trying to accomplish? Is this a negotiating tool? What are the deliverables going to be that you can announce from said meetings that are ramping up to the March 4th deadline versus, ultimately, is this a renegotiation of the trading partnership between Mexico and Canada? Again, why Canada? Why are we going after them? What do we really want from them?
You say it's consensus. And maybe it is, but I think the consensus think is dangerous on this issue because I find them incredibly unpredictable. I think it could still be the case that they go forward with these tariffs next week.
But this is the reason why it's important to understand what it is they want. Do they want a mea culpa? Do they want some sort of kiss the ring? Do they want something that's, superficial? And then is the political will in Canada right now not there to really deliver that because there's so much anger toward the neighbor treating you that way? So it raises these questions that are unpredictable, sort of like the rare earths deal with Ukraine and what we saw there, and that it seems like it was really a comportment thing and the way that the relationship was between Volodymyr Zelensky and Donald Trump.
The British Prime Minister will get an audience with the President a little bit later. The UK Prime Minister Keir Starmer arriving in Washington ahead of his first meeting with President Donald Trump today. Starmer expected to push for a deal where the United States would reinforce a truce between Russia and Ukraine with some security guarantees. And Starmer's doing the right thing, right? He's doing what the president ultimately wants to see, which is offer to push up defense spending and at the same time pull back on aid spending.
Which is giving him a win. Again, it goes back to that. How can he deliver that? Yesterday, he mentioned in the press conference about jobs that were being brought back from Apple, and we've already talked about that. I mean, he wants the wins. I will just say, Prime Minister Keir Starmer is going a step further, and he's being very smart about how he's framing this to Donald Trump by saying the U.S. needs Europe to succeed for its plans to be successful. And that is the reason why they need to be invested in the success of Ukraine. Again, this is for you. It's not for us. This is really, our strength is really a benefit for your greatness.
Anne-Marie is in the nation's capital this morning. She'll bring you some coverage of that story a little bit later. The main event, the earnings story of the last 24 hours, NVIDIA reporting some mixed results in its earnings release. The fourth quarter sales topping estimates by the smallest margin in some 2 years. The company warning that gross margins would be tighter than expected as it rushes to roll out its new Blackwell chip. That stock is up by 0.6%. Joseph Moore of Morgan Stanley raising his price target on the stock to 162, citing momentum in the large cap AI space. Joseph joins us now for more. Joseph, welcome to the program, sir. Appreciate you getting on for us this morning. I'm sure it's been a very busy 12 hours for you. What did you like in the earnings report that gives you confidence that we can achieve that price target?
Yeah, I think, you have to look at this quarter through the lens of a product transition. 2/3 of the data center revenue roughly came from Hopper, a product which is clearly, behind what Blackwell is. And so I think you had customers transitioning from Hopper to Blackwell. There have been some well-discussed supply issues with Blackwell, with the various complexities of the systems-level solutions that they have. And you grew the data center business 18% sequentially with that backdrop. And everything they said about Blackwell demand into the back half was what you wanted to hear. So, the gross margins were not as good as we had hoped. And I think that story is going to take time to play out. But I feel like we're past the worst of all of that. And I think looking forward, we have a very strong second half ramp of Blackwell. We continue to be in a very robust AI spending cycle. It's not a bubble. And I think that, this was actually a very good result in the context of transitioning to a new product, struggling with some of the productization of the new product, all that stuff we knew coming in. And I think they've done a good job with that. And I think from here, everything gets better.
Joseph, what do you do when a stock doesn't respond to what you call a very good result, when it's only up by 0.7%? Is there any information that you can take away from that story?
Sure. Well, I think that, to your point, it is a very good result looking forward, but there were some issues around it, right? I think some of that, the gross margin pressure was a little bit unexpected. So I think that's a bit of an overhang. And we had highlighted coming into the quarter, for really the third straight quarter, we sort of have a situation where in mid-quarter, people have worried about a lot of the NVIDIA issues. We've seen people, cutting numbers with a month to go in the quarter. And then going into the results, the previews were much stronger. I thought some of the previews were a little bit high. So I think there's some expectations issues in the near term. So obviously the gross margin issues, there continues to be an overhang of what the government export controls may look like. So all of that stuff is holding the stock back. But we're now heading into a very strong product cycle, and you have the backdrop of every hyperscaler saying how much they're investing in AI. I think that you could foresee some of this, I think, and certainly I think if things stay strong through the end of the year and that visibility remains strong from there, I think the stock can get to new highs.
Joseph, I want to sit on the idea of margin compression a little bit to understand the why behind it. It seemed like there were two features. One of them was the cost of the new data center equipment really was significantly higher than in the past. So this means that as they develop more advanced technology, it's going to cost more. And then they also have to pay their people more because they're trying to attract the top talent. How many of these issues potentially are longer lasting and more permanently crimp their margins at a time where some of the big tech companies that have been their customers are kind of under pressure to pull back a little bit?
Yeah, I think I view most of it as temporary. I think when you talk about gross margins getting back into the mid-70s in the latter part of the year, that's a healthy number. And we've been in the high 70s before, but to me, that's always been a little bit frothy. I think mid-70s is the place to land. I think what we can see here is the complexity of Blackwell has been significant, and what they're attempting to do, particularly moving people to rack scale solutions, where there's multiple issues that you incur above and beyond the chip. I think that's the primary issue, and I agree with you. I think it's the cost of expediting. It's not yield. I mean, they had more Blackwell than we anticipated, kind of understanding what the production is. So there's no issues with the manufacturing of Blackwell at this point, but I think it's productization that's costing them money, feels a little bit temporary. And I think going forward, you may see the company be just a little less ambitious in some of the roadmap issues because we're so far ahead of the competition here that we don't really need to push the envelope on manufacturability. And so I think when you see Blackwell Ultra, which is a product that they'll start talking about at GTC in March, I think there's much more focus on let's make sure that we're staying ahead of our competition. Let's make sure that we're ambitious in terms of what we're doing at the systems level, but let's also make sure that we don't have some of these snafus in terms of deliverability. And I think we're gonna see all of that. And so, the equipment is very expensive. There's no question. But I think we just heard a resounding commentary across the ecosystem that people are willing to make these investments. So, I think that the gross margins, it's going to take a little longer to get back to that mid-70s than we thought. But, I still think we're going to get there.
Joseph, how much was this earnings season for NVIDIA designed for an audience of one, where the discussion so much in the report was talking about some of the U.S. companies and how wonderful they are and the idea of U.S. dominance, and it was entirely discussing American technological prowess and not really addressing anywhere else, in particular China. How much was that an attempt to pivot toward something that was more palatable for President Trump?
Well, I think this is a major factor, right? I think the AI diffusion rules that were put into place in early January by Biden, are not taken off the ledger yet. So that was a 120-day implementation. So those rules go into effect on May 15th. But we heard a number of things from the Trump administration about different rules, new rules. So I don't think we know exactly what's going to happen. So I think what you are hearing is some attempt to make sure that we can continue to ship in these other regions. They did say some things that were calming. They talked about China being at roughly half of the level that we were at before the export controls kicked in. That's a lower number than I anticipated. But the vulnerability here is not just China. There are, under those AI diffusion rules, there is sort of concept of mid-tier countries which will need to apply for a license to build over a certain scale. And the presumption is they'll get those licenses outside of China. But is that a delay? Is that something that, will slow things down? And so I think NVIDIA is very much focused on that and would like to make sure that at least, they certainly are going to be very careful about doing what the U.S. wants them to do, but making sure that we don't get to licensing practices that slow things down, where the presumption is everybody's going to get what they need, and we just can't get it as quickly. They're moving incredibly fast to ramp this supply chain, and they want to make sure that they can get product in the hands of customers who need it, under the restrictions that the government's trying to impose.
Joseph, enjoyed reading the note this morning. Thanks for making time for us. Joseph Moore there of Morgan Stanley, the latest there on NVIDIA. Big scare over the last month for this whole ecosystem was DeepSeek. Would it lead to less spending from some of the biggest clients of the likes of NVIDIA? We've had confirmation over the past few weeks in earnings season that maybe it won't.
Well, maybe it won't. Some people are saying they're going to double down now, but there are still questions about what happens later. And overnight, there was a story about Google laying off more than 100 people in their cloud computing unit at a time where there's more of a focus on inferencing rather than training, which is a lot less intensive of some of these chips.
I wonder also, Lisa, whether it leaves some scouring for valuations for the whole ecosystem as well. Maybe there's a limit on a multiple that people are willing to pay now after being spooked over the past few weeks.
We've seen that with Microsoft and Alphabet. Their shares have not recovered. They're still down, and you just have to wonder what if that's the why behind why these shares didn't rally more on numbers that by any measure were pretty terrific.
NVIDIA in the pre-market up by 0.8%. Equity futures doing okay this morning, largely positive across the board. With an update on stories elsewhere with your Bloomberg Brief, here's Danny Berger. Hey, Danny.
Hey, John. Another big drop-off in yet another sentiment reading. The latest American Association of Individual Investors survey out this morning showed a collapse in those who are positive on the U.S. equity market. 60% of investors said they were bearish. That's up from 40% last week. It's also the highest reading since spring of 2022, when markets were marred by the start of the Fed's tightening cycle and Russia's invasion of Ukraine. Meanwhile, Salesforce shares, they are lower by nearly 4% in the pre-market trade. The company's full-year revenue outlook fell short of analyst estimates. The results dimmed optimism that Salesforce's new AI product would spur faster sales growth. Salesforce launched its AI customer service product, Agentforce, in October. The Agnelli family sold over $3 billion worth of Ferrari stake. XRNV, the family's investment vehicle, still retains 30% of the luxury car maker's voting rights. The sale proceeds will be used for a, quote, sizable new acquisition and a more than $1 billion share buyback. Ferrari said it plans to buy as much as 10% of the shares disposed by Exor. And that's your brief, John.
Danny, thank you. Why are you shaking your head?
How much do you have to pay to get Ferrari as the last story? And then you could talk about, let me tell you how beautiful their uniforms are.
No, that's not what I was going to say.
And NASCAR is nothing.
That's not what I was going to say.
And
Lewis Hamilton, top of the timesheet in testing, just in case you're interested. Up next on the program, the Doge purge continues.
Those million people that haven't responded, though, they are on the bubble. I wouldn't say that we're thrilled about it. Right now, we're trying to find out who those people are that haven't responded.
A conversation up next with Torsten Slok of Apollo as we look ahead to data at 8:30 Eastern Time. Jobless claims just around the corner.
Behind the bright lights and adrenaline of pro sport is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I love the fact that you have, we say the cojones, I can't say that in Bloomberg.
Maybe moxie?
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're an asset, but how do you become the principal?
Paul Rabel.
We're going to be the league of digital, and that's why you're going to invest.
Adina Friedman.
I definitely am competitive.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. No, nobody does that. They say, let's talk about the team.
And so many more.
You need a clap?
No, anywhere.
Ready? Go.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Equity futures on the S&P 500 positive here by 0.6%. In the bond market, yields are higher by 4 or 5 basis points. The 10-year 4.3020. Under surveillance this morning, the Doge purge continues.
I think that email perhaps was misinterpreted as a performance review, but actually it was a pulse check review.
Those million people that haven't responded, though, Elon, they are on the bubble. You know, I wouldn't say that we're thrilled about it. Now, maybe they don't exist. Maybe we're paying people that don't exist. Right now, we're trying to find out who those people are that haven't responded.
So here's the latest this morning. Investors eyeing impacts of Doge's federal layoffs in this week's jobless claims report, due at 8:30 Eastern Time. Torsten Slock of Apollo writing, the consensus expects total Doge-related job cuts to be 300,000. However, studies show that for every federal employee, there are 2 contractors. As a result, layoffs could potentially be closer to 1 million. Torsten joins us now for more. Torsten, good morning.
Good morning.
Haven't seen austerity for a while in this country. Are we about to see it?
Well, I think there are 2 important dimensions for markets of this. First of all, if the consensus estimates are right, and there are various numbers out there, but if we do see layoffs of around 300,000, that raises the first question, namely, is that a big number or a small number? Total employment in the U.S. is about 160 million. So in that context, 300,000 is not a lot. Total number of unemployed is about 7 million. In that context, 300,000 is not really a lot. And the total number of people who change jobs every month is about 5 million. So in that context, it's not really a lot. But if we do take into account that suddenly also contracts are now being canceled, and for every federal employee, there are 2 contractors, maybe then we could have another 600,000 that also could be impacted. So first, which is a number at 8:30, it becomes important to think about what would the implications be if we do see numbers in the 500,000 to 1 million in terms of layoffs. The second thing is also that if we now start thinking about, well, if there are in total about 3 million federal workers, and there are, again, 2 contractors, that's 6 million contractors, that brings you to 9 million people, and therefore potentially 9 million families that are now being impacted by potentially having the risk of layoffs. So that's why the numbers we got earlier this week for consumer confidence could potentially be a reflection that a lot of people are now being impacted by the risk of potentially seeing layoffs, and that may be why consumer confidence took such a significant hit earlier this week.
You know the longer-term hope. The hope is that as the federal government steps out, the private sector will step in, and we increase the dynamism of the American economy over time. That's the destination. How painful is this journey going to be?
Well, so that's why any adjustment in any economy, when you take people out of one sector, government, transportation, healthcare, whatever sector it is you want to change as a politician, if you take them out and you want to reallocate them to another sector, absolutely, it does involve periods of unemployment. It potentially also involves people who do not have the skills to go into the other sectors that you want to bring them into. So yes, any adjustment in any economy would be involving some pain, in this case, in the form of a higher unemployment rate.
I'm going to ask you a question that you asked this morning. Sentiment bad, hard data good. How long can it continue? So
the answer to that, of course, is that the incoming data, as you talk about, of course, all the time at the moment, is really strong. The number of people flying on airplanes is strong. The number of people going to Broadway shows is strong. Spending on credit cards is strong. CapEx outlook by corporates is also strong. But how long time can we have this uncertainty about both consumer confidence being weak and also policy uncertainty being so elevated and potentially for a more extended period? And the answer to that is that at some point you begin to worry about that it will impact hiring decisions. They will impact spending decisions by companies. So the answer to your question, Lisa, is at 8:30 and potentially also already as soon as next week when we get the employment report, we will begin to figure out, is this uncertainty just talk and uncertainty, or is it something that actually will begin to impact spending decisions by businesses and by households?
And this really is the key question heading into the remainder of the year. You were really strong about the idea that inflation wasn't coming down as quickly as people expected last year. And you were saying that essentially you didn't see the need for all of the cuts that we saw last year that led to the 10-year yield rising. Is that the same thing here amid all of this uncertainty, or do you think that the rally that we're seeing in bonds reflects a great weakness that could be longer lasting?
It is still the case, because if you really think about what's going on, we are turning towards a world with more segmentation. This is not only the US, we had the German elections on Sunday, and segmentation means that countries are essentially saying we are no longer interested in importing as many goods, and if we do import them, they have to be more expensive. That's inflationary. Also, generally speaking, there's also a drive towards saying we're not interested in immigration. That means that that's also inflationary, in particular for wages. And industrial policies in different countries are also now different. Different countries have different interests. That also basically means less competition, which also means more inflation. So on a number of different fronts, you can both have at the same time higher inflation and weaker growth, which is a definition of stagflation. It's a stagflationary shock when you see inflation going up and growth slowing down. And that just happens to be the backdrop for the conversation that we're having in markets at the moment.
Is the Fed cutting or hiking it to that?
Well, of course, the Fed now has the choice in the dual mandate to figure out how much weight do we want to put on the slowing growth and how much weight do we want to put on inflation sticking higher. So far, more recently, they have certainly been more worried about the inflation side of the dual mandate. But if growth does slow more meaningfully, if the unemployment rate potentially already hit 8:30 today, and definitely Friday next week, and the following months begins to go up, I do think the Fed will begin to put more weight on the growth risks with the argument that that potentially will eventually drag inflation down. But it's a very difficult spot for having stagflation as the input into the Fed decision.
Sounds like you're making a bit of a change, though, a bit of a turn.
Absolutely, because we're getting worried about the challenges coming from initiatives, not only in the US, but globally, in terms of what's coming from politicians, in terms of the restrictions on immigration, what's happening with tariffs, and also industrial policies that, generally speaking, again, are things that are inflationary.
Do you think tax cuts by the end of the year can change that conversation?
So I'll come back by the end of the year and we'll have that discussion at that time. But I think that what's, of course, most important now is that the initial policies that have come out on the table are inflationary, namely tariffs moving higher and also potentially something being done across the board towards different countries. And the more that we have the risk that we will both have higher prices and less sales, the more markets should be preparing themselves for the risk that a stagflationary scenario might be playing out.
Torsten Slok of Apollo. Torsten, lots to think about. Appreciate it, sir. Thank you. Bit of a turn from Torsten and the team.
Last year, it was about how much dynamism there was still in the U.S. economy. This year, the global discussion about how tariffs and deglobalization can increase costs, a really interesting one.
We'll build on those conversations in the next hour of Bloomberg Surveillance. We'll catch up with Jared Woodard of Bank of America, the former Trump trade official, Katie Kalukowicz. We'll also speak to Valdemar Zlezak of KKR and James Fishbach of Azoria from New York City. You're watching Bloomberg TV.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
In 2015, I was not optimistic because nobody was working on the hard problems. The energy R&D budgets had gone down. The venture investing in climate had gone down. It was completely out of fashion. So I don't know what people are optimistic about then. The fact is we built essentially from scratch with lots of supporters, a really mind-blowing level of innovation against emissions. And, in the last 9 years, that's gone better than I would have expected. So only now could you even, plausibly be optimistic about the path of emissions. And someone who said, hey, nobody's ever scaled things up like the speed that we knew to before, they're welcome to say, hey, I'll believe this when I see it. In the meantime, some people who care about this issue are really out, trying to think, do we need permitting reform? Do we find, what new ideas haven't we found yet? How do we fund people with those new ideas? How do we get the costs of these things down? How do we collaborate on a global basis? So we're still not at the point where it's guaranteed or even that it'll be easy, but at least there's a theory of change.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
There's a slowdown on the business side happening right now. The consumer is starting to run out of gas.
The economy is becoming a little bit weaker on the short term.
Inflation is still a big concern, but it's being replaced by all this political agenda.
Consumers are looking at these tariffs and they're thinking about the potential inflationary impact.
It's still, to me, too unclear whether these policies turn out to work out great for the U.S. economy or they're actually detrimental.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now, so let's start with the scores. On the S&P 500, bouncing back, up by 0.7%, up by 0.75% on the Nasdaq 100, encouraged by this in the pre-market. NVIDIA, a little bit firmer, off some half-decent numbers. If you speak to the analyst community, they will say, yes, they were underwhelming, but overall, these are very good figures. The question we've got to answer is, okay, if that's the case, why are we seeing a bigger move on a stock?
There still is an overhang of uncertainty about what the future looks like at a time of rapid technological change, at a time where potentially companies are going to get more efficient and buy fewer chips because A, a lot of their customers are saying, hey, where is the proof that this actually is going to increase revenues? And B, it seems like the chips are already becoming obsolete by the time they come out.
That's the tech story. That's the earnings front. Let's talk about the data. Talked about this a few times already this morning. If you're just joining us, data point of the morning, 8:30 Eastern Time, jobless claims. Why? The cuts to federal workers down in Washington. Are we already going to see that filter out to contractors and start to see that creep into headline figures? Torsten Stock of Apollo with us just moments ago, making a case for exactly that.
Saying it's about 300,000, but there are 2 contractors for every single federal employee that gets cut, so that ends up being about 1 million jobs, and then the families that get affected. I'm just wondering how the market treats that. If you can dissect that it is a DOGE-related increase in some of the jobless claims, does the market infer weakness from that? Do they ignore it? I mean, how is that read-through? I think the market response to that will be as interesting, if not more, than the actual numbers themselves.
We said a few weeks ago on this program, this is the most fascinating moment in financial markets I think we've had since the pandemic, because there are so many different things going on across so many different dimensions. We've talked a lot about trade, talked a lot about cuts down in Washington, D.C. and what it might mean for the data. Also need to talk about the potential of wars ending, Crude and energy prices coming lower as a consequence of that. We can talk about that. Also need to talk about the fact that they are planning to cut taxes at some point later this year. How far they're willing to go with that, I don't know. But at the moment, as we know, markets are very focused on the sequencing of things. So they're focused on the things that we're talking about up front. So that's Doge and that's tariffs. Where we are 12 months from now, this is what we talked to Steve Orth, the Federated, about just yesterday. Where is the policy putt going to be 12 months out, and should we skate towards that? What do things look like a year from now?
As Peter Scheer was saying, there's a really good outcome economically and from a market's perspective, and there's a really bad outcome from a market's and economic perspective. And which you choose to focus on becomes something of a personal preference, because at this point, you could see policies to emphasize either point of view. As you say, it might be a sequencing thing, and we end up with tariffs. We might not end up with tariffs. It might be a negotiation to lead us to a better end. Or it might be the confusion that stymies some of the deals that had been expected to go into place and then reduce some of the capital expenditure that was already planned and baked into a lot of valuations.
We're seeing some evidence of that in the early economic data points. It's still only February 27th. I keep reminding everyone, you know, it's week 5. It's week 5.
Almost
it's breathless
week 6.
already. It's week 5.
Almost week 6.
Equity futures right now in the S&P, positive by 0.66%. Coming up over the next 60 minutes, we'll catch up with Jared Woodard of Bank of America as markets react to the mixed outlook for NVIDIA. The former Trump White House trade official, Katie Kalukowicz, on the latest tariff threat. And look out for this conversation later this hour. James Fishbach of Azoria on a possible Doge dividend. We begin this hour with stocks looking to leave behind a 4-day losing streak after good but not great results from NVIDIA. Jared Woodard of Bank of America writing this: artificial intelligence may be the latest in a long line of technologies that raised broad productivity but did not recoup investment quickly, and not by their benefactors. Jared joins us now for more. Jared, welcome to the program, sir. A provocative statement just to start this conversation. Walk me through what you really mean by that.
Don, Lisa, I'm glad to be with you. It's a sequencing argument, just like you all were discussing about policy. I think there's a sequencing questioning among investors that's really becoming urgent for the market. When we look at the history of big innovations, big new technologies that transformed